We still think we're in a bull market. Obviously, we had a very horrific correction.
The bottom line, though, is we're getting a big spike in inflation.
The market's a little too complacent about the Fed not even talking about tapering.
It's going to be very, very hard for any central bank, frankly, to be more dovish than the Fed is.
It's hard for the Fed to maintain the degree of accommodation when the output gap is closing fairly rapidly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Bloomberg Surveillance on radio, on television today. An eventful Tuesday. Romaine Bostic in for John Ferro. Matt Miller in for John Ferro. Romaine Bostic on the Sikorsky right now, scheduled to be with us. Matt Miller in from Germany, similar. And that is a good and beautiful thing. Lisa, I'm looking at the clear and present market action now. People want to own the 10-year yield, which is driving the yield lower.
The great unwind of longer-term inflation expectations. That is what we are seeing in markets, and that is what is pushing stock prices up to near record highs. There is a question of how long-lasting this trend will be, with a fierce and fiercening debate between the economics profession about whether the Fed is taking the right approach or whether it risks a policy error.
And something we heard yesterday, Lisa, and it really continues forward today, is the elegance of the 5-year inflation-adjusted yield. Lower 10-year yield, okay, that's great. But the 5-year real yield just won't budge, and it's a very elegant chart. It just doesn't want to move to a lesser negative number.
And how much is this counting in the Fed continuing its $120 billion of bond purchases for a longer period of time versus just a low inflationary environment? Yeah. It's just amazing to see how much of the recent issuance of the U.S. Debt sales the Federal Reserve has picked up.
Matt Miller, do your John Ferro imitation, if you would. You got to fix your tie like this and, move your hands around like Ferro does. We all miss him. But Matt, do your imitation here of what the ECB stands for. All of a sudden, the ECB is upon us.
Yeah, and the ECB is going to be incredibly interesting on Thursday. I don't say that very often, but not only are they expected to raise forecasts for both growth and inflation, but they may change their language around their inflation target. And that could be key, because up until now, the target has been up to but less than, or close to but less than 2%, and they might drop the less than part of that, taking a cue from the Fed and looking to overshoot. It
is amazing, the moving parts right now, and of course there's a lot of other stories out of Washington, out of London as well, but we're really going to focus on the equity markets today. Ben Laidler with us in moments with eToro as well. Let me do the data right now, red and green on the screen. Matt Miller, jump in here on foreign exchange, and let's begin with Bitcoin as a currency alternative. Matt, 32,896. What is the crisis level in the Miller household right now on BitDog South?
I'm actually excited, because if the Feds have found a way to crack a wallet, maybe they can get me into my lost Bitcoin. In all seriousness, I think, this is one of the reasons that the price has come down a little bit. People ignorant of how Bitcoin works are starting to learn that it's very traceable, and it's easy for anyone to find out where it is. Now, getting it out of there is the problem.
Let's call it key support here at 32,000. Again, 29,000 was a memory from 10 days ago. In the real world, Brent crude 71.11, pretty much stasis around, but I really want to focus on the yield structure that Lisa and I talked about. Lisa, as well, you look at the World Bank.
Yeah, the World Bank is publishing its latest global economics report coming out at 9:30 a.m. Remember, back in January, they downgraded their expectation for global growth based on the fact that there were resurgences, flare-ups of the virus in various parts of the developing world. We continue to see those, and we continue to see a two-tier economy, developed markets getting far out ahead and not all on the same pace, while the developing world still struggles to get vaccinated and struggles to overcome the pandemic. How much will that feature into a slower potential growth? 10 a.m., this is interesting. We've got the April U.S. JOLTS job opening survey. This is a key leading indicator of just how quickly the jobs market is getting back on track. Of course, we've seen the openings rise much faster than the supply of workers to be able to come back in and take those those jobs. And then 10 a.m., and I want to really get to this because it addresses something Matt Miller was talking about, BitDog, Bitcoin, the fact that the Colonial Pipeline CEO is going to be testifying before a Senate committee. This comes after yesterday the government said that they had recouped about $2.3 million of the ransomware fee that Colonial paid to reopen its pipeline. Really throwing into focus, Matt said that the reason why the price was lower was because people were realizing that it's a traceable asset. Another reason why is because this might heighten regulatory scrutiny if this is the currency in which you end up doing a lot of these ransomwares or having some of this illicit behavior. There is a concern that this is really a tool for nefarious actions. And this sort of highlights this.
They should have just done it with dollars.
Well, I know,
they
and this is the argument. I knew, Matt, that you would go back. But I will say this, not when you're doing it, though, intercontinentally, not when you're doing it digitally. And there is a question about regulatory scrutiny and what that means longer term for the prospects of the likes of Bitcoin. Tom.
We will see on that. Thank you. Lots to talk about this morning. Right now, Ben Laidler joins us with eToro. I do want to get to the equity markets, but Ben, I like how you take your way too healthy breakfast index and you're up 54% in the Laidler commodity household right now. Tell us about the breakfast index and how it folds over into the commodity call.
Well, commodities, outside of crypto, is the best performing asset class in the world this year, and I think it sort of continues to do well. You have this sort of perfect combination, at least if you're bullish commodities, of it's still pretty tight supply and a lot of sort of disruption and underinvestment there, and obviously sort of growth just really rebounding. I mean, led by China, biggest importer in the world. Came out of the crisis sort of early, but now, as you were saying earlier, just really sort of broadening. You put those two things together, the whole commodity complex is doing well, and an ag and the cost of your breakfast, frankly, regardless of what you choose to eat for breakfast, is booming, and I think that has a lot of sort of impacts, right? If you're a producer, that's if you're Deere, if you're the biggest equipment producer in the world, that's great. If you're if you're a consumer, a lot of which is in EM, that's not so great, and more broadly, it just feeds this sort of narrative of which I think is overdone, but it feeds this narrative of sort of global inflation sort of running away from us here.
Yeah, Lisa, I looked at the footnotes, and the Laidler index is unfortunately way too healthy for me. It's got wheat in it and oats and barley and the rest of it. The Keene index, folks, after some careful research, it's weighted, and the Keene index includes Trix, Tang,
I was about to say, my Keene index would be Tang mimosas to Bloody Marys.
Exactly.
That would be basically what I would imagine. Ben, please save us. There is a question going forward about what's driving the equity rally higher, and a lot of people point to the lower yield environment. The idea, people are getting used to this idea that perhaps the Fed is correct, that inflation will be transitory, and that we will go back to a low growth regime that is absolutely a Goldilocks scenario. At what point do these low yields actually undermine the argument for equities, because it really suggests that growth is not sufficient to sustain these kinds of earnings growth?
I think the earnings story and the growth story has a long way to run here. I mean, you were talking about vaccinations and things earlier on. I mean, global vaccination rate, 11-12%. Lockdown index, 50 globally relative to 0 pre-pandemic. So I think the sort of reopening has a long way to go. We're going to get World Bank talking about global GDP forecasts today with the OECD last week, dramatic increases to their forecasts. So I think that's the narrative. The world's going to keep reopening. These GDP forecasts are still too low, and that's just driving earnings. And, we talk a lot about bond yields and high valuations, and, that's probably going to come down, and that's your risk. But I think the greatest insurance policy is earnings growth, and earnings growth just continues, surprise on the upside. You're going to get maybe 40% earnings growth this year. I think that's sort of consensus. But look at next year. Next year, consensus says you're only going to get 10% earnings growth globally. Really? With 4.5% GDP growth, 3% inflation, I think we're still really underestimating earnings growth, and that's what's going to take the market higher, and that's your insurance policy to the biggest risk out there, which is sort of lower valuations when the Fed does tighten, and they will tighten. The question is just when and how much.
The question is what happens when the Fed does tighten. Bill Dudley wrote a piece for Bloomberg Opinion yesterday saying they really, in that they are looking to push the economy to overheat now, they're going to have to tighten much faster later, and they could bring on a full-blown recession. Are you concerned about that?
I think we've priced a lot of this in. I mean, we obviously haven't priced a policy mistake in, and I'm not sure the Fed's going to make that. But I do think we've priced the tapering in and the first sort of initial Fed hikes. I mean, look where expectations for Fed futures are for next year. Consensus is that we got a hike next year. I mean, a year before the Fed already. Inflation expectations already sort of moved up. We had a bond market tantrum in the first quarter. I mean, in percentage terms, probably the biggest move in bond yields, we've ever had, or at least in living memory, and equities are up 6%. A lot of people talk about the 2013 taper tantrum. That was the best year for equities in the decade. Equities sold off 5% and then rallied another 30. I think the fact that we're having this conversation, markets have incorporated quite a lot of this already. Right. I mean, I do think valuations are going to come down. Valuations is the outlier, this sort of 20 times plus PE. As bond yields rise, that's going to come down. But as I said earlier, I think the insurance policy to that, and what more than offsets that, is this still underappreciated earnings recovery, which is coming through.
Well, Ben Laidlaw, I'm going to do the math for you because you're far too modest to mention 6 or 8%, whatever the movement is in the market, gets you out to a double-digit up 2021, and that's the Laidlaw prediction of 3 years double-digit growth. And so far, he looks like on the edge of geniosity. From eToro Global Markets, Benjamin Laidlaw joins us this morning. Lisa, I look at this as all, and to me, the focus that we have this morning, David Bianco to come up as well on the equity markets is just the gross underestimation here, the gloom that's out there, the tentativeness within this great bull market.
Well, there's a concern that things are priced to perfection and are not resilient to some sort of exogenous shock. And when people are asked what the exogenous shock could be, sometimes they point to cyber risks, which we've seen a growing number of. And just crossing the Bloomberg, we're getting signs that multiple global websites are shown as offline, including the UK government website. So we're getting more news on this, but also crossing in tandem is that JBS, remember the meat processing company, rebuffed calls earlier to boost cyber spending. This according to ex-employees, as reported by Bloomberg, because they didn't see the near-term profitability of it. Again, all just highlighting the potential risks of cyber crime in an increasingly cyber world, Tom.
Oh, we will see as well. Matt Miller, what do you see over in Europe very quickly, or what are you watching?
Well, I'm watching the euro against the pound, actually. It looks like it gained some legs, and I could finally afford that Ducati I've been looking at in Sheffield right now at 86 pence, euro pound.
Don't sell the Bitcoin. Matt Miller with us, in for John Ferro, Lisa Abramowicz, and Tom Keene. Stay with us with futures red and green on the screen. Good morning.
With the First Word News, I'm Ritika Gupta. A Senate investigation of the January 6th assault on the Capitol details mistakes made by the government, the military, and law enforcement. A report out today says there was a lack of training and preparation for Capitol Police, who were overwhelmed by the rioters. Police told senators they were left with no direction when command systems broke down. President Biden's talks with Republicans on his infrastructure plan appear to have stalled. GOP Senator Shelley Moore Capito says she's bringing no new counter offer to the meeting with the president today. He rejected the latest Republican proposal last week. Meanwhile, Senator Mitt Romney says 6 senators are ready to step forward with an alternative. He's ready to unveil their plan to a bigger group of senators. Meanwhile, President Biden has come out with a plan to secure critical supply chains in products ranging from medicines to microchips. A task force will focus on supply-demand mismatches and deal with near-term bottlenecks that could affect the economic recovery. The administration is also considering an investigation that could result in tariffs on certain magnet imports. The European Union is ready to consider tougher retaliatory measures against the UK over Brexit policy on Northern Ireland. The EU says the UK isn't living up to its obligations. It's been a major flashpoint since the UK quit the bloc at the start of the year. That's led to violent protests over new border checks and customs paperwork for trade crossing the Irish Sea. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
earlier today, the Department of Justice has found and recaptured the majority of the ransom Colonial paid to the dark side network in the wake of last month's ransomware attack.
Lisa Monaco there, the U.S. Deputy Attorney General. We welcome all of you on radio and television, and glad you're on old media right now because there are outages worldwide. Lisa Abramowicz, help me with these headlines if you would. I'm going to go to the basic idea that the United Kingdom government website is down, that according to the BBC, and there's a shocking one, Lisa, from Amazon.
Yeah, the idea that web services is also affected, and the New York Times website also down. These are pretty broad-based. Amazon Web Services is completely down, according to Down Detector, as well as the UK government website, that according to BBC. Reddit also having issues, really raising questions. First of all, what's causing this outage? But second of all, also how quickly we can get things back online and what types of international consequences there could be, considering especially how much work has been moved to web services, to cloud services in the wake of the pandemic.
The linkage to the digital world here, and we're going to rip up the script. We do that with Matt Miller, Lisa Abramowicz, and Tom Keene. John Ferro off today, and joining us, Martin Schenker, our Bloomberg editor-at-large and managing editor of cyber and old technology as well. Marty, this is extraordinary, and it really folds into the announcement by President Biden at 5 a.m., not so much on rare earth metals out of China like neodymium. I think I pronounced it right.
That was very good.
But I tried. I got the equations in my head. It's got ferric in there as well. But it's about a broader losing of control of our global logistical system, whether it's cyber, whether it's, as Lisa mentions, Down Detector reporting these outages. Now we have user reports of Spotify, Twitter as well from Down Detector. But it's a greater thing than that. It's losing control of the logistics of the world.
You know, and you, to a certain extent, you can thank Donald Trump for that. When he disrupted the global relationships around the world, he exposed real issues about our dependency on outside sources for strategic materials. And so Joe Biden has decided he's got to address it somehow, and his declaration yesterday does that.
At least I want to make clear, markets move on this. Futures are -9, Dow futures -140. They move on this, Lisa.
Well, and actually, if you look at fund manager surveys, the wall of worry is increasingly skewed to potential cyber risks. Marty, what are the specific actions that Congress is taking, not just with respect to some of the recent ransomware attacks that we've seen on Colonial, on JBS, but beyond that, to ensure that the infrastructure of the nation really is more immune to some of these attacks?
Well, Lisa, it is clear that there is bipartisan support for a substantial increase in spending for cybersecurity, but it's caught up in this whole stimulus discussion that has basically divided the Democrats and the Republicans. What they're going to have to do is carve out a specific fix for cybersecurity and get it passed.
Well, Marty, we have a great editorial on OPIN Go that shows the military is spending so much money, and we're talking hundreds of billions of dollars on legacy weapon systems that just aren't as useful anymore. They need to reappropriate that money to fight threats like this.
Yeah, and Matt, I hesitate to use the analogy, but turning that battleship around, the traditional military-industrial complex and the spending that's put into hardware versus software is something that has to be addressed, and it's not going to be easy.
What is the possibility that this White House can push for military spending on new age weapons? Certainly, they don't want to come across as aggressive. They seem to want. They seem like they would want to come across as the opposite of the Trump administration.
Yeah, you would think so. And maybe this morning's cyber attack, if that's in fact what it is, will energize people to actually sit down and work out a new way of approaching the security of the United States. And frankly, frankly, the world. This is not good for anyone.
This goes to the reset. To get back on track to the zeitgeist of the moment, the zeitgeist in Washington as the troops come back June 7 is this it's over for the Biden administration. They're now in a unique, original gridlock. How do you paint the new gridlock versus the old gridlock?
Well, the new gridlock is actually something that we talk about in terms of the center of both the Democrats and the Republicans and where they land in terms of getting policy done is going to be key. I mean, we're talking about Joe Manchin, we're talking about Christine Sinema, those kinds of people.
When we talk about the post-pandemic era, we talk about how a number of technological changes have gotten accelerated, including the adoption of cloud computing, of moving everyone's information to the cloud. That's why today's announcement that Amazon Web Services, one of the biggest cloud providers, is down. And this is according to reports. There is a question of whether this becomes treated like a utility by the government, given the fact that it is increasingly essential to the way businesses operate.
Yeah, and it's interesting. We talk about Colonial Pipeline, we talk about the Texas hack, and when the U.S. critical supply depends on a single facility, if that goes down, it exposes the lack of any kind of backup, which is critical for the economy to work.
And Marty, what's great about this is only Emily Wilkins could be on top of the story.
Oh, yeah.
Bloomberg.com is down. She reports, she just went on to business getting ready to be with us, and her report is the following: error 503, service unavailable. That's what comes up.
It's obvious that there's a extraordinary downage in internet.
To me, what's interesting here, Marty, it's got to come back to servers. And by no means are you and I experts on this, but you center on Google, Amazon, and Microsoft, the rest of them.
That's right. And if they can be hacked, then no one is safe.
Riley from St. Louis, folks, emails in and give you full team coverage here on this downage. Seamless.com is down, as she was out ordering a breakfast off the Tom Keene Breakfast Index. Tang.
Tang mimosas.
Sanka, and yes, more of it. As well. Lisa, we make jokes about it. This is serious. We've never seen this.
This is a huge issue, the idea that the likes of Amazon Web Services, Reddit, government websites, basically the New York Times, I mean, a lot of the essential news services, as well as just the infrastructure of the way people do business being interrupted. We don't understand exactly at this point exactly what was behind it. We don't know if it was something nefarious or whether it was unintentional. But, Tom, nonetheless, this highlights the risk of cyber disruptions of any kind in a world that's increasingly digital.
Yield comes in 156. We're down, round it down to 1.54, an extraordinary drop of 2 basis points in 10-year yield. Matt, it's real simple. They're going to go blame the Russians, blame the East Europeans, blame Matt Miller in Germany. Who do we blame?
Well, they definitely blame the Russians, right? Any chance we get, if a crime is committed by somebody in or around Russia, we always mention that whenever we mention the name of the group. I will say Bloomberg.com is still up. I'm watching us with about a 3-second delay on Bloomberg.com, and when I get home, I hope that Microsoft is still up because I want to play some Call of Duty
you work
on
from
Xbox
home.
Live.
Nice that you've got in there with Mr. Schenker on set. Matt Miller earnestly working from home in his 6-hour day. Stay with us. This is Bloomberg. Good morning. Bloomberg surveillance and an historic Bloomberg surveillance. Right now, there is a digital outage across America. It appears that Germany, where Matt Miller is okay. We'll get to that in a moment. Sarah House to follow up as well. Lisa, we do see markets moving. Equities were red and green on the screen now, solid, -11 on SPX. And critically for me, Lisa, this digital outage and the rumors and the reality of it has moved the 10-year yield down 2 basis points.
Yeah, although in some ways I'm surprised that there isn't a bigger move. I mean, we don't know, just to be very clear, exactly what's behind this. There are reports that Fastly is down, and they run a content delivery network that pushes data quickly around the internet so that businesses can help consumers shop or watch online. It's basically an intermediary, and that could be what's going on here. But really raising a question about how essential some of these services are. I mean, again, AWS, one of the main cloud servicing providers, if it really is down, what kind of businesses are getting disrupted disrupted and what kind of potential ramifications are there,
It's
Tom?
very fluid. Seeing Bloomberg.com, I just brought up moments ago on our screen here. We did lose it 5 minutes ago. It was not working. Matt Miller is in Germany. Matt, you haven't seen any outages, have you?
I haven't. I mean, I'm watching you on delay on my computer screen right now. So Bloomberg.com /TV is still broadcasting us live. I took a look at the New York Times for Lisa's sake. It's working here as well. Twitter is up. I'm still getting rude comments about my tie. So everything here seems to be working quite well.
Yeah, I very clearly hear Twitter was working for us moments ago. I get an error, 503 service unavailable on the New York Times. Let's do this. We're going to monitor this as well as we can. Our headline team is working on it as we get multiple sources, including TechCrunch has already weighed in. Futures deteriorate, -12. Dow futures -151. The VIX up a stick, 17.48. Let's try to get back on track with the American economy, and we do this with Sarah House, Wells Fargo Corporate and Investment Bank senior economist as well. Sarah, I think we're covering this digital story right now to a fairly well. Let us get an update on the state of GDP in America. Have you readjusted Q3 and Q4 guesstimates?
So when you look at the overall economic landscape here in the U.S., I think we've seen the supply issues become more acute in recent months. But these problems today, these issues around getting parts and materials, the depleted inventories, that slow return of labor, that really draws out the boom in growth that we're seeing. And we think that even as you see growth moderate through the second half of the year, that we're still looking at a boom economy as those inventories are rebuilt, as those workers return and support a solid pace of labor income over the second half of the year.
It's not your territory, but it's in chapter 23 of, Abel Bernanke and the rest of the textbooks we all studied. The yield has worked lower. Why are we having a boom economy with bonds bid?
Well, I think it comes down to what the Fed has been saying and their very patient stance when it comes to monetary policy. So even as we've seen some flare up of inflation, they're still very much focused on that transitory aspect. Take a drink, Tom. And when we look at the outlook for inflation, that we are seeing some, we do think that it'll fade to some extent. I think there's still a lot of questions over, okay, it might be transitory, but how high and for how long? But I think right now the drivers are pretty well understood. They are largely coming from these supply bottlenecks that will eventually abate, as well as some service sectors very much tied to the reopening. And so I think that understanding has kept yields in check.
Sarah, thank you for keeping Tom in check with the transitory drinking game. We have to talk a little bit about the latest news, the idea that there are all of these outages in essential websites. We don't know how long this is going to last. We don't know what's behind this. But it raises a question about the fragility of where we are in markets, how price to perfection, what kind of disruptions could create an economic dent that is not currently priced in. Based on your intersection of economics and markets, what's your sense on that, on how price to perfection we are with the market screaming ahead?
Well, I think what we've seen is that the growth expectations are very much priced in. Again, I think there is some fairly general understanding that the inflationary pressures that we're seeing will abate. But I think we are in a pretty unique period of monetary policy. So the Fed's policy stance and their new framework is largely untested. And so I think with that, as you see various disruptions, various risks come, you could see some increase in volatility. But I think the fundamental backdrop remains still very constructive for the U.S.
Although, Sarah, this does raise a question. If there is some sort of exogenous shock at this point, what ammunition does the Fed still have to actually give a boost to the economy, given all of the stimulus they've already pumped in?
Right. So I think where the Fed is, it's still pretty limited in what else they could do if we did have a negative growth shock. So I think they would rely more on their communication tools. So more recently, we've seen them inch towards this discussion of potentially tapering, or at least talking about tapering. And so they could reverse course on that again. While we've obviously seen extensive amounts of asset purchases, plausibly they could could increase those even further. But I think your basic point is well taken, that they are pretty limited in what else they can do at this point.
How important is debt to GDP, Sarah? If I look back to the year of my creation in 1973, we were only looking at 30% debt to GDP. Of course, that ramped up after the great financial crisis from 60 to 100, but now we're looking at 130 and heading higher. Does that matter?
I think what's more important is the debt service relative to the not necessarily to GDP, but what's happening in terms of whether it's household income, corporate income, government revenue, and to that extent GDP growth. But when we look at the outright stocks of debt, that's not as big of a focal point anymore, just given how low interest rates have trended in recent decades. It really comes down to that debt service, which remains exceptionally low right now. But there, of course, the risk is that if we do see interest rates rise, particularly if they rise faster than what's expected right now, that could create an issue in the short term where that debt service rises substantially and leads to a pullback in whether it's corporate investment, household spending, et cetera. But right now we are starting from a very solid place in terms of
I'm just wondering
across sectors.
I'm just wondering what happens as we look at $6 trillion of fiscal stimulus, $12 trillion of extraordinary Fed activity. I mean, how much longer can we, if transitory inflation is the only unintended consequence, why don't we just keep taking from this magic money tree forever?
Well, I still don't think we fully know how this story ends. But I think in the meantime, when we're looking at that debt service, I think this does allow us to at least experiment a little bit longer here, where and to the extent of, well, what does this actually do to growth? So are we putting this towards things that will actually improve capacity, improve productivity, and raise the profile of GDP over time, versus is it just merely transfers that doesn't? I think right now we are seeing that this supports stoked demand, and I think you are seeing some that pass through to some extent to stronger capital spending, which could have some beneficial effects to growth longer term.
Sarah House, thank you so much. I have to leave it there with what's going on in the digital space. She's with Wells Fargo this morning. Lisa, Barry Ritholtz out. He's at home working on this as well. I believe Mr. Ritholtz attends us later this morning. Usually doesn't start his day till 9:15, maybe 9:20. But Barry reports the New York Times is back up, Bloomberg is back up. And to me, Lisa, the great distinction of this digital and futures recover -12, we're now -3. The great distinction is AWS, Amazon Web Services, sort of versus everything else, and particularly Google. Out on Twitter, and I got to be very careful, the zeitgeist, Lisa, is that Twitter's off of a Google platform and was fine, and a lot of others are off AWS and they were not fine.
Look, there's going to be a lot of post-event analysis.
Yes,
in other words, what exactly happened.
Event.
Yeah, and how the infrastructure needs to be shored up, especially given people's reliance on it. I will say, when you take a look at the market moves, Tom, the one consistent move that has stuck, I mean, you said that we're seeing some of the retracements of the losses in equities. Bitcoin still down. And this, to me, is really significant because it really stems from this idea, what is the danger to digital currencies if there is some threat to the digital infrastructure?
Matt, weigh in on that. I can feel that.
I can feel the energy.
I got scalded right here on my face.
I think Lisa makes a great point.
Oh my goodness.
That is a huge threat, and a lot of people talk about the fact that post-apocalypse, when all you need is water, guns, and Bitcoin, you'll be able to spend it. But you need power and you need the internet to be able to do it.
Yeah, and actually, in some ways, the entire ecosystem around the internet is really complicated. And that, I think, is something that really Congress has to explore, the idea of what they need to do to shore it up, especially, Tom, as an increasing number of businesses rely on web services. I mean, we're talking about Fastly, the sort of intermediary possibly being the problem. Yeah, go carry on, Matt.
If I can just put, the problem is an increasing number of businesses are dependent on web services from two companies, right?
Yeah.
From AWS iOS and Microsoft. And if something like the internet computer starts to work, then it's a different story.
Which starts to really, Tom, systemic importance, right? It shifts from perhaps the banking sector to the tech sector. And at what point does that become a concern?
But in our digital addiction, let's assume it's all better now. I don't know if it is or not. We were down for what, 20 minutes? I was without web services for 20 minutes. How can I possibly survive?
Well, if you have a critical function.
I agree. Like, trading the next Bitcoin. Yeah, I get it.
No, I mean, listen, if it's a healthcare issue where you're, let's say, doing a remote surgery from somewhere and you need to get it over. I mean, there are a lot of ways where you could see it being a critical time difference. These are just things that need to be explored, Tom.
It's good, Lisa, to have Matthew Miller with us because the pendulum of post-apocalypse is upon us.
Yeah, we've moved from gloom to post-apocalyptic
reality. How can we book somebody to be on this show more gloomy than you? I just don't see that's possible.
Thank you, Matt. We appreciate it.
Matthew Miller with us for another 20 minutes. I think that's a good thing. Stay with us. Futures recover -1. An eventful morning. Good morning on radio, on TV.
With the First Word News, I'm Rishika Gupta. Multiple websites around the world are experiencing outages today, as we've been talking about. Amongst them, the New York Times, Reddit, and the British government. That's after services from content delivery network Fastly went down. Fastly pushes data quickly around the internet so businesses can help consumers shop online or watch videos on apps and websites. Vice President Kamala Harris is warning Central Americans do not come to the U.S. She said that if they do show up, they will be turned away. Harris was in Guatemala as part of the administration's efforts to address the so-called root causes of migration from Central America. The CEO of the fuel pipeline shut down by hackers testifies before a Senate committee today. The appearance by Colonial Pipeline's Joseph Blount comes a day after the Justice Department said it had recovered the majority of the Bitcoin ransom that was paid. Blount's expected to explain why he authorized the multi-million-dollar payment. And the Senate could vote as early as today on legislation designed to increase U.S. competitiveness against China. The bill calls for spending more than $200 billion for domestic semiconductor output and increased federal research and development. The perceived threat from China has united Republicans and Democrats in Congress. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
What we're seeing is that the variants that have emerged appear to be more likely to get kids sick and potentially get them sicker. And so, the idea that, well, this is just a common cold in adolescence isn't necessarily true. We don't want our kids to face even a small risk of a catastrophic outcome. It really does make sense to vaccinate.
Joshua Sharfstein from Johns Hopkins yesterday on the pandemic. We're going to get to Amish Adalja in a moment. Thank you for the many comments worldwide and across America on our coverage of the digital outage. We've really tried to coalesce here all the different flows. And Lisa, I guess we can say it's good news, down -12 on SPX. We come back to a slight green on the screen. Can we say crisis over, Lisa?
That seems to be what the markets are saying, and certainly Fastly, which is that intermediary, is saying that the issue has been identified and that a fix has been implemented. I love this by Sven Henrik on Twitter. A relief rally in progress as a 0.1% dip was a lifetime buying opportunity. Evidently, that's what we're seeing.
That's what we're seeing now, and the different sites are, I guess, coming back on. We'll continue to cover this with a bit of digital sobriety. Right now, Matt Miller, Lisa Abramowicz, and Tom Keene. Mr. Miller in for John Ferro this morning with Amish Adalja of Johns Hopkins, who's been absolutely wonderful about perspective. Amish, what I hear in the zeitgeist is a legitimate fear of the variant, but in every conversation, the variant is over there. The variant is in Australia. The variant is in some selected part of Africa. Is the dreaded variant in America?
There are multiple different variants circulating in the United States, but what makes it different when there's a variant here versus in India or in Africa or Brazil or even Japan is the fact that we've got so much of our high-risk population vaccinated that these cases of the variant don't necessarily translate into hospitals going into crisis. And that's why we prioritize the vaccine to those individuals who are most likely to be hospitalized. And when you look at the vaccines, even if variants might be problematic for symptomatic infection, meaning some people can get infected even if they've been fully vaccinated, like with the South African 1351 variant, when it comes to what matters, severe disease, hospitalization, and death, the vaccines are extremely good. And you have to remember, that's what the vaccines are meant to do. It's not meant to drive COVID to zero. That's not going to happen. What we're trying to do is remove the ability of COVID to cause a public health crisis, and the vaccines do that.
Another thing in the zeitgeist, Dr. Adalja, and I would suggest this is in your global wheelhouse. I think of Albert Koh at Yale University as well. Does good nutrition protect us from a worse outcome from COVID? The fact that we are well nutritioned compared to other poor countries, does that matter?
It does matter in certain aspects. If people have nutrient deficiencies, if people are vitamin D deficient, they're more likely to get COVID. They're more likely to have a severe case of COVID-19. But I would argue, even though in the United States we might look good in terms of nutrition, we have a different part of malnutrition. We have an obesity crisis in the United States. And I think the fact that most Americans are overweight really did synergize with COVID-19 and get a lot of people sicker than they needed to be if we weren't such an overweight, obese country. So yes, I think it's important to have proper nutrition, but you can also kind of be over-nutrition and have obesity on the other end, which can put your country into a problem too when it comes to respiratory infections like COVID.
Dr. Adalja, we're at a place where a lot of people, particularly in the United States, are able to get vaccinated if they so choose. What's the latest science in terms of wearing a mask, not wearing a mask? What's appropriate for somebody who's been vaccinated, and what risk they pose to others in terms of transmitting the virus?
So if you're a fully vaccinated person, you could basically go back to your pre-pandemic life. Breakthrough infections are extremely rare, meaning someone who's fully vaccinated. It's something that happens 0.000% of the time. And when it does happen, most of those cases are clinically insignificant, meaning they have no symptoms and they're not associated with transmissibility. So I think if you're fully vaccinated, go back to your life. You don't necessarily need to wear a mask. There are some caveats for those who are immunosuppressed, so I would talk to your physician if you are somebody who's had an organ transplant or is getting chemotherapy about what precautions to take. So you, as a vaccinated person, aren't a threat to others. That's the important thing to remember, and others aren't a threat to you.
And Matt Miller, the global index that the World Health Organization looks at was very constructive last night. That would be 25,000 plus at Fenway Park as the Red Sox took out the Marlins.
Wow, we had actually 27,000 at the MotoGP race in Catalonia over the weekend. So people
I have no idea
are
what
coming
just said.
back. I want to ask about the kids, Amish. I mean, I know you spent a lot of time at skate parks hanging out with Tony Hawk and Mark Gonzalez, etc. Are the kids getting vaccinated? Are anti-vaxxers just, 40, 50-year-old people, or is that prevalent among the kids as well?
Well, it depends upon where you look. The children have been getting vaccinated, but this is the early days of vaccination in the 12 to 15-year group. So the early adopters are definitely taking advantage of the fact that they can get vaccinated. We are seeing some parents who don't want their children to get vaccinated. The news about that link that's being investigated, the very rare myocarditis or the inflammation of the heart, that's also kind of making some parents vaccine hesitant. I think it's less important to see vaccine hesitancy in the 12 to 16 or 17-year-old group than it is to see it in the adult group, because we know that children in general are going to be less likely to be severely sick with COVID-19 and less likely to spread it. But yes, I do think there is some vaccine hesitancy, but what we're looking at now is the adult population. That's where we really want to see the needle move, because those are the people who are going to be more likely to be hospitalized, especially as they get older, especially if they're overweight or have any other comorbidities. But I think we're still on a good trajectory to end the public health emergency in the United States, because our high-risk population, 65 and above, is about 3/4 fully vaccinated.
Dr. Adalja, you have to leave it there. Thank you so much for your continued support in helping us understand this pandemic. Dr. Adalja with Johns Hopkins Center for health security and a senior scholar there. And really, Matt Miller, I look at Dr. Adalja and I can say he's one of the few people that's tried to keep the hospital beat going as a research scientist. He's in the trenches throughout this entire thing.
He's absolutely, I talked to him yesterday at 7 p.m. and he was still in his scrubs in the ER. So he is putting in the kind of work that is saving lives. He is on the front lines and really fighting this thing, and you got to have a lot of respect. At the same time, I've seen him on the skate ramp. The guy has talent when it comes to skating, so he's a double threat.
I like that. Lisa, what's your update on the schools as we stagger to June?
The update on the schools is that in the fall, people agree that they need to get back in person, and I think that every parent needs to agree. Honestly, stop the show. Amish Adalja saying if you're fully vaccinated, you can go back to your pre-pandemic life. I mean, just showing the split, the fissure within the medical community, because you've got some doctors, even within the same camp, saying that that's not the case, and others saying, go ahead, you don't pose a risk to anyone. Here we go with a really confusing myriad number of rules around masking.
As we go to break here, let's talk about the digital disruption we've seen this morning. It isn't all clear, and particularly is seen by the markets from +1 to -12 on Standard & Poor's futures. We go back now to +2. NASDAQ 100 doing better as well today. The 10-year yield as a barometer was down to a 154, and we've come back. We split the difference and come back to a 155 as many of these sites come back up, centered around, it appears, AWS. Coming up, Al-Husseini of Columbia Threadneedle on rates. Lisa demanded this interview. Good morning.
We still think we're in a bull market. Obviously, we had a very horrific correction.
The bottom line, though, is we're getting a big spike in inflation.
The market's a little too complacent about the Fed not even talking about tapering.
It's going to be very, very hard for any central bank, frankly, to be more dovish than the Fed is.
It's hard for the Fed to maintain the degree of accommodation when the output gap is closing fairly rapidly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Bloomberg Surveillance on radio, on television, and digitally wired this morning. A digital outage appears to be good news and much better right now. We'll touch on that in a moment. Romain Bostic in for John Ferro this morning. Lisa, I want to go from the uproar of up 2 to -12 on futures, and back up we go. But boy, does it show the fragility of the system as we know it.
Well, and certainly the big moves were not that big, right? I mean, the fact that people clamored in to buy a 0.1% dip does not necessarily give you a sense that there's real concern out there. However, there are some serious moves that are consequential from this. FireEye, for example, which protects against certain cyber snafus, up nearly 2%. You see the Amazon Web Services down. You see Fastly, which was part of what was going on, also lower. So the question is,
for the close?
No, well, look, but these are all raising questions about the new dynamic of the new economy, and it really leads to stock picking going forward when you try to think about the cyber world we live in.
Well, the stock picking is seemingly doing better here on a more macro basis. Romain, your thoughts on this? I mean, you're dealing with this every day. Yeah. The digital of the moment as well. Is it just, like on T-Live right now, Giles Turner leading our coverage. For those of you on Global Wall Street, T-Live, T-L-I-V is the way to go. It's really, really smart analysis. What's your take on this, Romain Bostic?
Well, they've got it back up and running. Fastly is critical. I mean, a lot of people don't know about it, but basically anytime you're logging on to do anything right now, you're probably being routed through a proxy server run by Fastly. There's a lot of other competitors out there as well, so if Fastly can't get it done, there's several other companies that a lot of people will gravitate to if this does prove to be something a little bit bigger rather than just, a one-off incident here.
To be clear, on radio and TV, I think we can say all clear right now. We'll correct that.
Are we up and running? Are people able to watch us?
Well, I don't know if we're up and running. We had 12 viewers in the last hour. Maybe we're up to 14 in this hour. Futures red and green on the screen. The yield was down to a 154. We come back a basis point to a better 1.55. Higher yield, yes, less angst. The VIX was out of stick and comes right back in from a 17 level into 16.57. I'm going to dispense with the rest as a churn this morning. Dollar with some strength. He's smarter than we are. That's why he's on on. Nate Langston joins us. Right, let's do this first. Lisa, why don't you go through your brief, because we have David Malpass coming up later.
Yeah, David Malpass will be speaking on the Open, 9:30 a.m. The World Bank will be publishing its latest global economic prospects report. He'll be talking a little bit about what they're seeing, what the potential risks are, cyber attacks, although we don't know that this was anything related to anything nefarious in terms of what happened with Fastly. Interesting to see, in January, they actually reduced their forecast because of some of the delays in the developing world with respect to viral strains flaring up. Then at 10 a.m., the April U.S. JOLTS job openings report comes out. Job openings have been surging. The number of individuals who actually are going to apply for those jobs have not been keeping pace. That, to me, is one of the questions. What is this dissonance really looking like, and how much are we starting to bridge that gap? And then at 10 a.m., Tom, I know you're so interested in this. The Colonial Pipeline CEO is going to be testifying before Senate, talking about some of the ransomware, again, showing the focus on the cyber infrastructure of the nation, Tom.
Well, maybe a little different than what we see right now, although I'm sure the Gloom crew will conflate the two. Again, a better digital structure right now. To get us started here, we're going to go to fixed income in a moment, but we're thrilled that Nate Langston, working with Giles Turner over in Britain, could help out this morning, European tech editor as well. Nate, what is the thoughts from London on this digital? Do we go down narrowly to Fastly, or can we say this was about Amazon Web Services?
Well, at the moment, from what we're seeing, is that there was a major error with Fastly server. There's no indication that this was necessarily nefarious in origin. That should become clearer later on today, I would hope. But at the moment, I would say that we do tend to see outages like this affect some of the biggest web hosting providers, even ones the size of Fastly. And it's kind of, it's to be expected that these things happen. What's always critical is how quickly do they come back. And as you noted earlier, we do see now that most of the websites that we knew were being affected do seem to be back online. And I'm looking at Fastly's own internal service status that says that a fix has been applied. So this is probably about 30 to 45 minutes total outage, which is reasonably accepted as okay. But we'll have to see what the cause is.
So what this means, Lisa, is Fastly's not helping Jeff Bezos go into space. That's what the summary is.
Well, that could be your way of interpreting it, and we could talk about sending Matt Miller to space. There is a question, though, Nate, of how we judge the seriousness of a type of disruption like this, considering how widespread it is, how many different places it affects. I mean, from your perspective, what are the ramifications of an outage that you said does get resolved within 30 to 40 minutes, but affects the mainstay of so many businesses?
Yeah, I mean, if you're somebody who is in charge of keeping a massive website online, then you're going to be weighing up the fact that you could either stay with a hosting provider like this, where there is a occasional risk that you'll have a temporary outage, versus the cost and uplift that goes with moving to a rival. That's not an easy thing to do quickly or reliably necessarily. So my expectation is that the fallout for this will be very limited, given the short amount of time, relatively speaking, that this was out for. And most companies that do dealings with a business like this will have a service level agreement that doesn't say we guarantee 100% uptime. But again, we'll have to wait and see what the cause is, and then we'll know more.
Nate, thank you so much, and thanks to your team in London that really drove our headline coverage on this in the last hour, with Giles Turner leading the way. Right now, we're going to go to fixed income. Ed Al-Husseini with us with Columbia Threadneedle on global rate strategist. Lisa, I've got to check my website and see if I'm still up. Why don't you ask the first question, Ed?
All right, Ed, there's a question here. We've been talking all morning about how there's a new paradigm in the yield space where people are sort of accepting that the Fed is correct and that we're going to be in a low-inflation world for the foreseeable future once we get past this blip. What is your sense of what could change that view in markets?
Yeah, hi, thanks. So I think there's sort of two areas where there could be a little bit of slippage. The first is the conversation around the taper and the taper timeline. At the moment, markets are really fixated on the Jackson Hole meeting in August and then the September FOMC as a space when the Fed will feel comfortable enough to make that announcement. I think that's a very compressed timeline. There might not be enough time for us to accumulate enough data for the Fed to move forward. And therefore, that gets pushed further out into the fall, potentially next year. The second is really the conversation around inflation. And, unfortunately, it's very likely that we won't have certainty around the underlying inflation process until we're well into next year to make a judgment in terms of whether inflation has kind of shifted up a gear into a higher zip code.
What explains the recent drop in yields here? I mean, we saw a creep up, a couple of weeks ago. It seemed like we were headed in a different direction, and now today we're sitting at about 155 on the 10-year yield and appear to be going now in the opposite direction that a lot of people think that we would go, given the general outlook for the Fed.
Yeah, look, I mean, if we look at the first quarter, we front-loaded that big move higher in yields on a number of factors. First and foremost, the opening of the economy, the vaccine introduction, and the upgrade in terms of growth expectations. But second, and in my mind equally important, was the change in the fiscal outlook. We had the Georgia election come through, and the fiscal outlook changed, quite dramatically. And we've done a really good job of pricing that in. And so by the time we arrived in sort of late March, in the March FOMC, expectations for data had ratcheted up to a point where it was very difficult to, again, beat them. So over the last, 3 or 4 months, what we've had is data coming in that's actually pretty good, but data disappointing expectations in that process.
And
so,
I mean,
if you look at
I know you're not day trading at Columbia Threadneedle, but let's go there. We talk about demand pull and cost push inflation. Now we've got demand pull, cost push, lower yields. I believe we have higher prices and lower yields. Is this the mother of all bond opportunities to move to higher yields?
I don't think so. Not yet. I think if there are places on the curve that are a little bit mispriced, it's probably in the belly. In my mind, if you look at real yields in the belly, about negative 200 basis points, 80 basis points in nominal terms, there's probably a little bit of room for us to move higher there, and that would be consistent with markets pricing in a little bit more of a faster hiking trajectory in 2023. So there's room there, and that would be consistent with, again, higher inflation expectations creeping back in. On the longer end, the big wild card is fiscal. Again, the conversation around the infrastructure plan is in molasses in D.C. We're going to get, hopefully, a little bit more clarity by the time we get to the fall. But if that infrastructure plan is funded via deficits, we have a very different outlook for rates than we do in an environment where that's funded by higher taxes.
Ed, got to leave it there. Ed Al-Husseini, thank you so much. Columbia Threadneedle, global rate strategist here as we continue with the digital outage. Lisa, what I notice is different now is all of the digital outage chat is beginning to come out in the past tense. I mean, I guess we don't know where we are, but the answer is we're talking about it happened last hour.
Well, the idea that it was resolved within 30 to 40 minutes means that the potential ramifications aren't that great. That's according to Nate of Bloomberg, who is just on. There is a question, though. Yeah, correct. Thank you. There are some moves, though, that are sticking, and I know you are laughing at me. And Romain, please don't laugh at me, because actually I do think that it's significant. The idea here that Fastly was down about 2.4% ahead of the open. This specific concern, Amazon affected, Microsoft not. Yeah. How does that weigh into their business model?
Well, what does that say, Romain Bostic, about the big cap companies?
Yeah, well, first of all, I mean, I think one question that we wanted to get into, Nate, was this idea of concentration. There is a really heavy concentration when you talk about some of these proxy networks. Fastly is obviously one of the smaller players here, but you get Amazon Web Services go down, and I hate to break it to you, Tom, but Bloomberg surveillance is pretty much kaput for the day. We should point out that right now, crossing the wire, Fastly is confirming that its global network, Tom, is back online.
Well, there it is. I mean, we'll have to see. I don't know. It sounds to me like it was Fastly. That's what I hear from Giles Turner in London.
Yeah,
we'll continue with this on radio and television. An eventful day. I thought it was a snooze fest. Forget about that.
You always think it's a snooze fest.
That's true. Red and green on the screen. Futures up 5. They've come back 16 big points off the digital outrage. I like that. This is Bloomberg. Good morning.
With the First Word News, I'm Ruchika Gupta. A problem that caused multiple websites around the world to go down has been fixed. That's according to Fastly, which says the customers may see an increased origin load as global services return. Amongst the websites that experience outages, the New York Times, Reddit, and the British government. A Senate investigation of the January 6th assault on the Capitol details mistakes made by the government, the military, and law enforcement. The report out today says there was a lack of training and preparation for Capitol Police, who were overwhelmed by the rioters. Police told senators that they were left with no direction when command systems broke down. President Biden has come out with a plan to secure critical supply chains in products ranging from medicines to microchips. A task force will focus on supply-demand mismatches and deal with near-term bottlenecks that could affect the economic recovery. The administration is also considering an investigation that could result in tariffs on certain magnet imports. The European Union is ready to consider tougher retaliatory measures against the UK over Brexit policy on Northern Ireland. The EU says the UK isn't living up to its obligations. It's been a major flashpoint since the UK quit the bloc at the start of the year. That's led to violent protests over new border checks and customs paperwork for trade crossing the Irish Sea. And in China, Tesla's deliveries rose 29% last month from April, when production was temporarily suspended. The electric car maker handed over more than 33,000 locally made vehicles in May. Now analysts are watching to see if a run of bad publicity in China will translate into reduced sales. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
What we're not going to get in June, but we need is more clarity about the balance sheet. I think they're going to tell us they're talking about it, but they're also going to tell us it's too soon to really lay out the parameters of what they do in terms of tapering and balance sheet movements more generally.
Bruce Kasman, J.P. Morgan, their chief economist, very informative yesterday on the enthusiasms that J.P. Morgan has, even with a potential GDP nicely set under 2%. We welcome all of you this morning. Romaine Bostick for John Ferro, Lisa Abramowicz, and Tom Keene. A very eventful day. We've done a lot on the digital story. It's back up and running. Let's move on from that right now. Jack Fitzpatrick joins from Bloomberg Government. Jack, buried in all the news flow is the basic idea of how the Democrats regroup. How do the Democrats regroup?
On infrastructure and their big legislative priorities right now, it's unclear what their path forward is. There's still an attempt for President Biden to work something out with Senate Republicans directly, and there is going to be a meeting with Senator Capito today, although Senator Capito, as of late yesterday, was not sounding very optimistic. She said she didn't have a new offer to give the president, and the president still wants much more money from Senate Republicans. So we may actually potentially see a Senate bipartisan approach where a bipartisan group of lawmakers start working together. But there really is some frustration among Democrats, and it's possible we'll see them give up on the bipartisan approach altogether for their top legislative priorities and do something through the budget process that lets them just use a simple majority. Senate, but they need Joe Manchin for that.
Okay, great. So that's reconciliation, is that process. How many more things can they slam through reconciliation before the parliamentarian says enough?
They have another opportunity, at least one big opportunity. They can use the next year's the budget blueprint to do something big on infrastructure. They also have some limited opportunities to actually amend the one that they previously used to then save the opportunity to use the 2022 outline. In other words, there are some limitations and it's an opaque process, but they could have up to 2 within the next year or so opportunities to do something partisan. But if they do go the partisan route, there are a number of lawmakers on the Democratic side who want to see one big package. So they've got enough of an opportunity as long as the moderates like Joe Manchin and Kyrsten Sinema get on board with doing things the Democrats' way and not working with Republicans.
Jack, one of the reasons why it's so great you're in Washington, D.C. is because you can kind of get the chatter in terms of how optimistic or not people are that something will get done. Given the latest developments between Capito and President Biden, what's your sense on the likelihood of a deal getting passed, and what would the headline number actually be on a bipartisan level?
I wouldn't say there's a lot of optimism right now. As of late yesterday, honestly, I wasn't entirely clear on why Senator Capito is keeping the conversations going. She said Biden told her there needs to be more money from Republicans. She accepts that, but she does not have a new offer that she's prepared to give. The conversations have revolved around the number $1 trillion, but when you get into the weeds and look at how much of that is new money, how much is pulled from unspent stimulus funds, and how does it compare to money that would have been spent anyway by the government, it's a big difference. Biden wants $1 trillion in new money. The $1 trillion proposal from Republicans actually was closer to $250 billion or so in new money above the baseline. So you're going to hear the number $1 trillion a lot, but then the details can get pretty messy, and the president wants an actual $1 trillion in new spending that we otherwise would not have seen.
So a lot of oxygen right now being sucked out of the room as they sort of try to work through this infrastructure bill and all the sort of related spending bills out there. There's still other legislation out there and other proposals out there with regards to cybersecurity and a lot of other things that are still really important that need to get done. Is there any sense here that there's a little bit more consensus on those proposals?
Well, on cybersecurity, clearly there's a lot of attention on the issue. One challenge they face is that there's a very spread out series of jurisdictions in Congress. My colleague Rebecca Curran has details on the fact that there are actually about 5 different congressional committees with relevant jurisdiction on the issues we've seen with the Colonial Pipeline hack, the fact that that's an energy issue. TSA actually has jurisdiction over pipeline cybersecurity. It's a bit of a knotted up web of government jurisdiction on this issue, which does complicate the effort. But there is obviously bipartisan concern about those kinds of issues, cybersecurity for pipelines and elsewhere. So that's sort of one of the main challenges right now. But it is something that you'd expect to see move forward. It's just clearly not at the top of the list of negotiations right now.
Okay, so bipartisan concern, not necessarily bipartisan movement. Let's talk about maybe some of the issues that are a little bit more on the progressive side of the equation here, like the voting rights bill that Biden was proposing, which at least for now appears to be dead, and some of the other more progressive measures that Biden really needed his full Democratic Party behind, and he doesn't appear to have that at all.
Yes, the latest on the voting rights measure is the criticism we heard of it from Senator Manchin. That potentially could be a moot point even because a voting rights measure is something that really doesn't lend itself to the process, the budget process, budget reconciliation that allows them to pass things with a simple majority in the Senate. So things like voting rights, police reform, some of the progressive priorities that are not fiscal priorities are things where you'd really need to see bipartisan support. And it's not even clear that Democrats have all 50 members in the Senate in support right now. So that's the toughest part the Biden administration.
Jack, thanks so much. Jack Fitzpatrick with us, and he is up, wired, and running at Bloomberg.com as well through the morning with Bloomberg government as well. Lisa, it had to happen. Ivan the K out on Twitter. He's already flagging the black T-shirt. I survived the Fastly outage of 2021.
It was rough.
It was just a matter of time.
I mean, we're going to get lots of paraphernalia, bumper stickers, hats. Who's a survivor? Look, we make jokes because it took 30 to 40 minutes.
But at the time, it was stressful.
Well, at the time, we didn't know. Really? We could all hold hands. You're going to call Dr. Phil? You got him on speed dial. Tom?
I don't know. There it is. Romaine, we've been here before. I mean, to remind everybody, we've had outages before. Like this, and there it is, and we all go mental.
Yeah, we've had actually worse outages than this. But look, I mean, it does show you, and Lisa, I think, brought this point up earlier about just how critical internet infrastructure is now to everything we do in our lives. So any disruption of that, even if it is for just a few minutes or so, does cause a lot of outages.
And to pick up on your point, Romaine, earlier, this idea of concentration risk, how does this sort of play into this concern about AWS and Microsoft, Azure having so much of the business, Tom?
Right. Are we going to get a home phone line?
Don't get carried away. Come on.
I mean,
no.
Crisis. Are we going to get
on everything? My kids don't even know what a home phone is. Like, they don't know about the buttons that you press.
Yeah. You don't know.
Rotary phones.
When you could listen to your neighbor's conversations.
Yeah, that was great. And the operator would listen in.
Some of them weren't appropriate.
You're not that old. Come on.
Great, Tom.
Futures high for the day, up 6. Stay with us. This is Bloomberg. Good morning. Bloomberg Surveillance. Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. John Ferro is off. Romaine Bostic holds court this morning. Red and green on the screen. It has been an eventful morning of digital outage, digital recovery, and on we go, maybe to a more normal day of June. I do want to point out Brent crude sliding back down from the 72 level, $70.81 on Brent crude, and it also knows some dollar strength this morning, although let's call it fractional as well. Much to talk about. We'll go to the equity market here in a moment. But first, Romaine Bostic with individual stocks. You start with Fastly?
Yeah. Well, why not, Tom? I mean, where were you during the great internet outage of 2021? It lasted for about 30 to 45 minutes. Fastly shares did take a little bit of a leg down, as did Shopify and Amazon. They are off the floor right now, so still down here on the morning, down about 1% here in the morning. Interesting, Marvell Technologies, which actually just came out with earnings. This is the big semiconductor company. It's interesting because most of their business actually goes to these cloud services types and proxy companies like Fastly. Their earnings actually were pretty good. Good earnings in the quarter and a relatively decent guidance going forward. Tesla shares getting a nice little bump here in the morning, up 2.7% at 621 here. This after you had some delivery numbers out of China that seemed to assuage some of those fears that there was a slowdown in deliveries over there. Of course, this is just 1 month of numbers, so we'll see what happens when we get that next month, but at least for now, that seems to be calming investors. You flip up the board, some of the other movers on the day, Stitch Fix came out with earnings last night. It's all about those accessories. Accessories selling well on that site. Those shares having a phenomenal morning right now, up about 14%. And you also got Clover Health. This is interesting. We talk a lot about the meme stocks here, Tom. The meme stocks like AMC, they are slightly higher on the day, but there's a lot of rotation into some of those other stocks. Clover Health, of course, that's Thomas Palahapitiya.
The rotation? How do they determine what is the next meme stock?
Well, I'm pretty sure it's just called crowdsourcing, Tom. I'm not sure there's a lot of fundamental analysis going on, but we have a lot of folks at Bloomberg who sort of troll a lot of these message boards. Of course, this goes way beyond Reddit into the Telegram boards and the Discord service as well. You get the little chatter there, and all the people on Bloomberg put it. If you have a Bloomberg terminal,
it's a roulette wheel, Tom. Come on.
There you go, Tom. Here you go. Clover Health, Wendy's also being chatted about on a lot of the boards out there, Tom. Don't ask whether there's a real fundamental reason for it. This is what we call momentum. Remember in the old days, Tom?
Oh, really?
Yeah.
How quaint. Romaine Bostic, thank you so much giving us the momentum of the market, and that is futures up. NASDAQ up a nice 0.4%, up 54 points. What we're going to do now is calm down. We had Ben Laidler with us, I think, an hour ago or so, with his optimism on double-digit returns 3 years in a row. David Bianco probably takes a more measured approach with DWS Americas and their CIO. We're absolutely thrilled that Mr. Bianco could join us. And really across the arc of this pandemic, Lisa, I really want you to weigh in here. You and I remember the remotes. We had to parachute in at one point, 3 makeup artists to go to Lisa's house because they couldn't get up. They couldn't get up.
Because I couldn't do it myself. That's the real reason.
Lisa, think what we've been through and those garbage remotes we did with the delays and, all the, first of all, the camera and lighting guy showed up drunk once. I don't know what that was about.
You had a camera and lighting guy? Wow, please do go on. Look, it is wonderful, though, to have people.
Lisa, please weigh in here. Think what we went through over the last 14 months.
It's been exhausting. And for a lot of people, and people have gotten used to working from home. It's a little bit more challenging when you're dealing with the broadcast logistics. But right now, the world's waking up, and you can see it in Midtown, Tom.
There's literally a team of 200 people worldwide in London, even in Asia, that help Bloomberg Surveillance every morning. And this is what it's about. A guest hermetically sealed in studio with us. We welcome David Bianco of DWS. Wonderful to have you as a guinea pig. Check your insurance. David,
and liability waiver.
Yeah, I want to talk in your very considered note of how we measure optimism forward. You're optimistic, but we got to measure it out into Q3, don't we?
Right.
Well, there's a lot of ways to measure optimism. One of the more direct ways is simply to look at the valuations. However, when we assess valuations, we have to keep in mind that we're in a very different interest rate environment than history. So when we try to estimate normalized earnings and then capitalize those earnings at a fair return, that alone, the low interest rates justify high PEs. And with still at an above 20 PE, I don't think the equity markets are exuberant, but they're definitely optimistic about not just sustained recovery, but a long-lasting expansion. And so are we. We are just trying to stay focused on the risks of inflation, possibly higher real rates. That might weigh on the PEs of the market.
You were a student of this at Wharton, and you go to the real issue is we have to gauge the shock that we know is coming. So we've got a fear about what's coming down the road. The Fed comes in and all that, the end of fiscal largesse, et cetera. You don't fear that, do you?
But we are concerned about that, and we have been trying to move the conversation from the immediate inflation risks, which we think are more cyclical in nature, commodities, supply chains, the reopening, and we believe those inflation risks will pass, that they are transitory. However, there is a significant risk of more sustained inflation from fiscal largesse and this expansive fiscal and monetary policy. That's what we're watching, and we're looking for signals on that out of D.C. this summer. And what I'd like to say is that when it comes to fiscal disciplinarianism or disciplinarian from the markets, if the bond market is dad, the currency market is mom. And the bond market hasn't shouted yet, but we're watching the dollar to see if the dollar can, it's been tested. We think if it slips further, it will cause rates to climb.
The problem is mom's at the Gucci store. That's what's going on here for real. We welcome all of you on Bloomberg Television and on Bloomberg Radio. David Bianco of DWS with us in the hermetically sealed studio. I've been pickled, so he's safe. Lisa, you're still unsafe in a separate room.
I'm still hermetically sealed over here. I love the idea of mom being currencies and dad being the bond market. David, there's a question about diversification in a world where you've got such polarized risks. How do you diversify in this new world?
Yeah, that's the best concept of them all. When you can always fall back on diversification, and when there's uncertainty, we and investors do that. So we are diversified across asset classes. We are diversified across equity regions, and we are trying to be diversified in our styles and segments and having our portfolio managers pick stocks. But we do have our preferences, and we are modestly overweight equities, mostly because we're concerned about the longer-term inflation and likely higher real interest rate risks to the bond market. So we're slightly overweight equities, but our preference is foreign equities, Asia in particular. And when we're shopping in the United States, we're aware of certain things doing well cyclically, semiconductors, banks, but it's not the 1970s. We think the real inflation risk is more monetary and fiscal in nature. And we rather move from things like energy, industrials, materials to, if you haven't already, banks and what we consider to be better inflation protection plays should inflation become more broad-based. We think banks are actually a more effective inflation protection play, and you'll find value there.
Yeah, absolutely. And we've already seen a pretty good run up in a lot of those bank stocks. I am curious, you mentioned Asia there, David. What about Europe? I mean, they've kind of gone toe to toe here with U.S. equities, kind of held their own. And of course, you got a big rate decision coming up out of the ECB where you might get a little bit more guidance and a little bit more divergence out of the bank over there in Europe versus the one here in the U.S.
So we are overweight foreign equities, and we're equally overweight Europe and Asia at this moment. But Europe is more of a reopening play, and the European economy should continue to improve and accelerate over the course of 2020 into 2022. And we still like Europe. But we think what's likely to have legs for the next several years is Asia. And for the next several years, still the growth stocks of the United States, I would say, not just tech and communications and internet retailing, but also healthcare. Let's not forget about the innovation of biotech. And upon economic strength that's long-lasting, tech is also a good play, and so are financials.
Is there anything that worries you here about the economic recovery, either here in the U.S. or globally? Any potential speed bumps that you're keeping an eye on?
I'm worried about politicians and policy setters trying to be helpful and doing too much. We're going to look to see if these stimulus packages, infrastructure, human social infrastructure packages that are likely to come, and we want to see if they're right-sized, if they're well-targeted, if they're likely to produce good return on investment. These are the things we're looking at, because if they're not good uses of the country's savings, it will lead to higher inflation and higher interest rates, and that is a threat to the valuations of financial assets.
David Bianco, it's just wonderful to have you in studio with us, and it really harkens back to, it is 2021, and we go back to the previous pandemic of just after World War I. Do you believe in the Roaring '20s? Do you believe in the the excitement we have of you coming into our building, somehow getting through security? I have no idea how that happened. But you took the COVID test and all that. But does this action of you to be our first guest in studio in 13, 14 months, is it about the allusion to the Roaring '20s?
I'm constructive on the economy, U.S. and worldwide. I think we're likely to have a good expansion. I don't know if it lasts 10 years or not, but I think we have a real recovery in process. I don't think the Roaring '20s are the right analogy. First,
what is that?
Probably something more like hopefully.
The hopefully 20s?
the hopefully the 90s of productivity and benign inflation and interest rates and good incentives. But look, the 20s, first off, I would point out the early 20s, 1920s, was not a good economy. It was deflationary. It was a lot of trying to put things back together.
Early depression in England as well.
Well, exactly. 1921 was a nasty recession. So people forget that the 20s weren't good until the late 1920s. Yeah. But more importantly, that was an economy that it did benefit from strong global trade after the war, and it did benefit from strong physical capital expenditures, investment spending, railroads, things like that. However, this economy's digital in nature. This economy's focused on healthcare. These are the things that an affluent society wants and needs, and I think it's important that we stay focused on who the innovators are in that sense.
Well, talking about that, David, I mean, we survived the Fastly outage of on what is today, June 8th, 2021. There is a question of how you gird against possible disruption going forward, whether it's the Colonial Pipeline, whether it's idiosyncratic, whether it has longer legs. How much are you accounting for cyber risks, for cyber potential benefits for specific companies in your portfolio?
We are accounting for that as a risk, but also an opportunity. I think when it comes to cybersecurity, when it comes to electronic digital payments, payment processors, we're excited about security in the digital world and facilitating payments and other conveniences in the digital world. But when it comes to things like cryptocurrencies, we think you need to ask yourself a more fundamental question. What does it take to make for a viable currency? And we're not sure crypto has that yet.
David Bianco, thank you so much for joining us today. When you leave, it's like the movie E.T. You're going to go out through the white tunnel. Be careful of the guy with the keys on his belt. David Bianco leaving us. And really thanks to all within our building here at 731 Lexington for getting our employees in every day, and particularly our valued guest, David Bianco of DWS, the first one. And Lisa, that's pretty exciting.
Yeah,
I didn't know this was going to happen.
Yeah, it's exciting to see people in person. I mean, honestly, I personally have used Zoom. I know you've never used Zoom. Romain's used Zoom. Yeah. I mean, it's tiring, that little delay in between two conversations, I find.
I mean, Romain, it's a big deal. I'm sorry, Romain, it's a big deal. It's really symbolic of where we're headed.
It is symbolic, Tom. I actually like when you were broadcasting at home and you were sitting in front of that closed blinds.
It was all cute as all get out. It was great. Vet bill on my lap and the whole thing, folks. You have no idea.
Remember the beard?
In all seriousness, it is actually wonderful to actually see an actual real guest in the flesh for a change here. I mean, it has been a tough year and a half here for a lot of us, and I'm sure for a lot of our viewers. So any sign of normalcy, I'll definitely take it. Although, why are you referencing E.T.? I didn't quite get that reference.
It's because he's leaving. David Bianco to leave here has a security thing, just like in E.T. at the end of the movie. They're in the house.
Okay,
that was like 4 years ago.
Yeah.
Well,
David left the door here, and I heard somebody, Bianco's gone. I said, he has DNA. That's what they said.
No, I do think, though, what he said about the hopeful 20s is really interesting. Maybe not the roaring, maybe the hopeful. The question is, what will get fulfilled?
Oh, Wilson, this is way too much optimism for Bloomberg surveillance.
Yeah, I can't deal with that.
I got to get back to the Tang Mimosa. Red and green on the screen with the NASDAQ up nicely. That's a lead for this morning. And the yield, that's a stunning yield, 1.5483%. That means David Bianco's right. Stay with us on radio and television. This is Bloomberg. He's got DNA. Yes!
There are some countries that are below the 15%. Quite a few of them are above the 15%. I mean, if we were able to achieve a circumstance where all multinational companies operating globally are required to pay at least 15% on their profits, I mean, I think that is a very significant step forward.
Matthias Cormann of Australia, his first interview as Secretary General of the OECD. We are honored to have that conversation with him yesterday. Just absolutely fascinating. We'll drive forward the institutional dialogue. David Malpass scheduled to be with us in the 9 o'clock hour. I believe Lisa Abramowicz leading that conversation on the open. Red and green on the screen. I'd say a modest advance off the digital uproar that we've seen this morning. I heard the first shirt. I survived the Fastly 2021 outage was bought by David Wilson. He paid Bitcoin for that, and he joins us right now. What do you got this morning, David Wilson?
What I've got is David Kastner, who pays attention to sectors over at Charles Schwab, basically cutting his rating on the financial group to a market perform from an outperform. I mean, he really kind of favored the group for about a year. And, among other things, he's pointing out that what's going on in the stock market with financial shares is inconsistent with what we're seeing in the bond market in terms of treasury yields. So, you have the relationship there between the S&P 500 financials index and the broader S&P 500. We've seen it move up, this ratio between the two, by about 9% from a low back in April, and over that time frame, the 10-year yield basically went nowhere.
I mean, Lisa, jump in here. This is your wheelhouse. I mean, I don't get it, and the chart says on radio, all you need to know is it's an I don't get it chart.
Well, this is actually what I was wondering and thinking about when David Bianco was saying that he was favoring financials. This is a call, it's consensus across a number of different houses on Wall Street, and the question really goes to what David is highlighting, David Wilson, that basically you've seen yields go in the other direction and increasing expectation for bond yields to fall, and not just yields to fall, but that yield curve. When it steepens, typically banks make more of a profit. They can lend out their money for more on a longer-term basis. When it narrows, it doesn't. We are seeing it narrow, and with expectations actually being pulled back, Dave, how much do you see other shops on Wall Street also retracing their thesis on financials as a result of this?
Haven't seen a lot of that yet. I mean, clearly there's a focus on the group, and I suppose you could argue, well, body in motion remaining in motion because financials have been among this year's best performers when you look at the 11 main industry groups in the S&P 500. So it's not like, there's really a consensus call to back away. You see how the numbers line up for the year to date. At the same time, though, I mean, this inconsistency between what's happening in the stock market with financial shares and what's happening in the bond market with treasury yields, it's noteworthy. And certainly the idea that Schwab sort of picked that out as one reason to take, at the very least, a less optimistic view of the financial shares. I mean, that gets your attention.
David Wilson, thank you so much. Return to Bitcoin. He's back from Miami. Toughest gig at Bloomberg, Michael McGlone, Bloomberg Intelligence, Miami strategist as well. Let's do it. Before we talk about BitDog at 32,000, Mike McGlone, what'd you learn in Miami? What was the surprise of the great believers?
Hey, Tom, I'll never go to another conference like that. It was a coming out, and it just happened to be subject of Bitcoin. It was completely packed. The main hall was wall-to-wall people standing normally. They had pushing people out. And when you walked into the exhibition hall, the main thing you feel right away is you feel that heat of humans. There was just so many people there. And my sense is, okay, is this a peak or is this a sign of Main Street adoption? I see a lot more suits, a lot more people with, with prime banks and accounting firms. And no, didn't see any bow ties, hardly any ties. Perfect. So to me, my bias, it's probably more Main Street adoption. I did have some great conversations, and the best conversations, as you would know, behind the scenes, where you talk a little bit less about Bitcoin, and I brought up Ethereum a lot.
Yeah. So, Mike, I mean, I think we really have to make sure that next year we get Tom down there to Miami to host Bloomberg Surveillance Live poolside down there. In addition to all the evangelicism going on about Bitcoin itself, there was a lot of talk here about the idea of replacing banks, or at least maybe minimizing the influence of banks in the process here. Is that actually a strategy here that actually is beneficial to the future of Bitcoin?
Well, I think it's more right. The way I look at it, Romaine, is what Bitcoin is helping do on a global scale is bank the unbanked. And the statistic that really hit home is only 2/3 of the world's population does not have bank accounts, and 40% of those people have cell phones and smartphones. So to me, that's where Bitcoin comes in. It's really happening. Look what just happened recently in El Salvador. They might adopt Bitcoin as their currency. So that's where one thing that's really notable about this conference, there's a lot of do-gooders there who've made a lot of money, and they just want to make the world a better place. And they think Bitcoin is the main on-ramp to do that.
Well, do-gooders perhaps that are getting fueled with $4.1 billion in profits. That is the entire profit for just the last year for American traders. This coming out of Bloomberg this morning, a report on the terminal. I'm just wondering, going forward, what kind of regulatory regime people were talking about. Did anyone care about regulation, or was that basically not even an issue that was discussed?
Regulation in Bitcoin is kind of already done. We already have futures. The next regulation key thing is a matter of SEC approving some kind of ETF. The key area where regulation should come in, which really wasn't the subject of the conference, is in stablecoins like Tether. Because we just found out the feds caught the people trying to do ransomware with Bitcoin. That's the whole idea of Bitcoin. It's a immutable ledger. You can see where things go. That's how they caught the Silk Road. But if you want to really, hide transactions, you go to a privacy coin, not Bitcoin, or go to maybe a stable coin like Tether. That's probably lacking regulation, but it's coming. It's just a matter of time.
Mike McGlone, thank you so much. Wonderful to have you back with Bloomberg Intelligence, our commodity analyst on, yes, commodities, and also on Bitcoin. I look at this, Romaine Bostic. I look at, XBT currency. We've pretty much decided it's not a currency, right?
Yeah, don't look. Well, is it a currency? Is it a commodity? Who knows? 33,000 right now. We have seen a little bloom come off the rose here, and I think Mike kind of alluded to it. Is all of the coming out parties that we've seen for Bitcoin and crypto over the past few weeks, is that really a signal of the top? Was that the peak? It'll be interesting to hear, because a lot of hedge funds, a lot of the institutional investors are at least making the case here that there's a floor. There's a floor here, Tom. Whether you believe it or not, who knows?
Floor, for Elisa's technical talk for support. Support's maybe is a round number, 30,000. Like, what do we do at 29 or 28? Well, I'm not predicting we're going there, but, support, floor seems to be where we are.
I'm also wondering how much leverage is embedded within the crypto bets. Michael Saylor of MicroStrategy is raising money through selling junk bonds to buy Bitcoin.
This should go over well.
This, to me, is fascinating. This came out yesterday, this idea that he's offering 6.25% to 6.5% yield on a junk bond, and he's going to take the proceeds and use it to invest in Bitcoin. I mean, this is, of course, new. It's the first of its kind. Tom, I know you're registering this, but to me, it raises a question of not only are people buying Bitcoin, how much are actually people using borrowed money to do so?
And who's buying those bonds?
Well, it hasn't happened yet. It's unclear how much demand there will be, and it's unclear whether he's actually going to be able to pay the low rate of 6.5%. You're not buying it? Triple leverage Bitcoin junk bonds?
I'm just going through like the 400 history examples of this. I mean, if you're doing high yield 600 basis points over the cost of money to try to make it. I mean, it's like telling somebody you're going to guarantee 21% in a hedge fund so you can do the 2 and 20 payout.
Yeah. Well, meanwhile, you got 154 basis points on your 10-year.
Can I note that NASDAQ is up 0.5%? That's a pretty good move for the market this morning. Stay with us on radio and television. We're digitally wired. This is Bloomberg. Good morning.
I think the sort of reopening has a long way to go. We still think we're in a bull market. Obviously, we had a very horrific correction.
The bottom line, though, is we're getting a big spike in inflation.
The inflationary pressures that we're seeing will abate, but I think we are in a pretty unique period of monetary policy.
It's hard for the Fed to maintain the degree of accommodation when the output gap is closing fairly rapidly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The great inflation debate of 2021 heating up. Good morning. Tom Keene, Jonathan Ferro, Lisa Abramowicz. John Ferro off today. Romaine Bostick tolerating us for another hour. We really have to focus on the markets, what's going on with 10-year yields in particular. The idea here that we've been talking all year about inflation picking up, about whether perhaps the Fed is staying on hold for too long, and here you have the 10-year yield down to 1.54, a material shift lower.
Well,
Tom.
Lisa, you've got a 153 handle, 1.5398. That is absolutely extraordinary. What percentage of the zeitgeist, Lisa Abramowicz, is that pushing against?
Yeah, well, it's massive. And if you look at the camps,
that's the right word.
If you look at the camps, they're deepening. You've got the likes of Bill Dudley on one side, and then you have a whole host of professionals, including Nobel laureates, coming out and saying the Fed has it exactly right. And the markets right now remain very much weighing in and saying that the Fed does seem to have it right, at least for the time being.
Hey, the other thing I'd look at besides a Bitcoin bid off, we may get a 32,000 print again on Bitcoin, is, Lisa, within the data blur, the quiet of the FX market to me is really, really important. I loved what we heard earlier where one of our guests said, Mom is the FX market and Dad is the debt market. I thought that was pretty good.
I do too. I'm setting up a real battle between the two that really feels somehow familiar.
So
Romaine,
why
there is a question.
Assume it's a battle between the mom and
the mom and pop. So what's Bitcoin? What is that? Like crazy uncle?
Romaine, can you just weigh in though here? NASDAQ actually futures at session highs, up 0.5%, and this stems from the low yields, but it also potentially stems from the boost of the cyber issues that we saw. I mean, what are you seeing in that area?
Well, we should point out we saw this correlation before with the low yields a couple of months ago when we saw those yields drop, and we saw a little bit of a pop here in some of those big cap tech names here. People tend to gravitate back to this as a form of safety here. They may not be as sexy as some of the sort of mid-tier tech companies and some of those cyclical names that a lot of people have been piling into. But when people look for steady growth, they look for reliable revenue and reliable margins, it always comes back to those companies, Apples, the Microsofts, and Amazons of the world. They haven't disappointed so far, and people tend to gravitate back to those.
I do wonder, Tom, if it's a correlation or causation with low yields and big tech.
I don't know, but it's a lead story today. Again, 153.98 and the 10-year yield in almost 3 basis points is a huge deal, and that's off that digital outage. If you're just joining us, a major digital outage this morning, Fastly linked into AWS. Of course, the details of that will be reported out through the morning. But Romaine, we can go all clear on that, can't we?
Yeah, we can. I mean, Fastly basically came out, said everything's basically been resolved. There's going to be a lot of questions over this, and you see the bid into some of those cybersecurity stocks.
On the data, let me just touch on it quickly here. Red and green on the screen with NASDAQ 100 leading the way up 0.5% as well. The yield we've mentioned 3 times at 153.98. The real yield doesn't give me much, 0.86%, negative 0.86%. I should say currencies on board. This is a really important conversation. Like, let's be honest, folks, for your 201k, this is the conversation of the day. Saira Malik has tangible real-world work in small-cap portfolio management and rides herd at Novine Global Equities over conservative money. We're thrilled she could join us this morning. Saira, there's a huge body of intelligent, balanced, managed money. They've done all the right things. They've rebalanced, blah, 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 and they all feel behind. What do those people do who are in conservative, balanced money that haven't performed?
I mean, the issue has been that, a lot of people tried to market time, and we learned last year that that's a loser's game. And, when the pandemic hit, we saw people pulling their money out of the markets, putting their cash on the sidelines, and then trying to wait for a buying opportunity. And, that's a tough sell when you look at equity markets that have been up, double digits on an annualized basis for a decade. And, going forward, we actually think the markets tread water for a bit as we continue to be concerned about inflation and taper talk. But we do see a catalyst coming up, and that's second quarter earnings. They should grow at over 60%. And really the next leg of this cycle could come during Q2 earnings. When companies talk about outlooks, what we're looking for is Capex spending. We think that could really extend this cycle. We see low inventory levels, increasing industrial production growth. And if that Capex really picks up, it's good for the economy, it's good for the markets, and specifically for industrial sectors, which is an area that we like.
Saira, does this mean that the bond market is wrong? I know you focus on equities, but your view really feeds into this contrast that we see, the optimism for 60% earnings growth paired with a 1.53% treasury yield.
Yeah, I mean, the bond market to us is saying that they see an increase in interest rates, but it's going to be orderly, well communicated. And that when we look at yields, we think that the yields are catching up to inflation expectations, and investors are. And that's why we're seeing yields settle at this point. We think going forward, a mild increase in yields, maybe up to the 1.75 to 2% level by the end of the year. Market should be able to handle that as long as growth remains strong. And that's what we expect to see.
How does this sort of line up, though, with the general expectations about inflation, which I keep being told is something a little bit more than transitory, something that could potentially be persistent? Square that circle.
Our view our view on inflation is that it's going to keep causing volatility, because what we didn't expect was for the data to spike at a much higher level than we would have hoped for at the beginning of this year. So a higher spike in inflation in the near term, but then eventually it settles. We do expect to see that shift from spending on goods to spending on services. So it's going to be pockets of inflation rather than broad inflation. However, what would worry us again is around second quarter earnings. We need to hear what companies are saying about wage inflation. We're seeing these supply issues and this weaker than expected payroll data. If wage inflation really picks up, that's a key component of overall inflation. Then we do need to start worrying that it's more than transitory, and the Fed may have to pull the ripcord, react a little bit earlier than we all wanted.
All right, so how do you diversify, Saira?
I mean, you diversify, I think, within equities, you need to start looking outside of the U.S. U.S. has had very strong returns for over a decade now. Outside of the U.S., there's lagging markets, emerging markets. We like areas such as China. We even like Europe over the near term as that reopens. And then severely lagging countries, which are coming soon, hopefully, out of their COVID issues, like India and Brazil look attractive to us. And then outside, you can look at other asset classes. Within fixed income, there's still interesting areas like emerging markets. You need to be more selective, focus on some quality areas. And then you can also move into some real assets that are more heavily hedged for inflation, which could be a positive for your portfolio.
Sarah, percolating here with the underperformance of so many people is the theory of rebalancing. Simon Constable in the Wall Street Journal a few days ago wrote just an absolutely brilliant article, which I know you agree with the whole rebalancing thing is sort of carried away, and there's over rebalancing. How does Sarah Malik rebalance?
I mean, I don't think rebalancing always needs to be something that you automatically do. I think you need to look at rebalancing in areas where there's valuation discrepancies and also catalyst in terms of what you're looking for. So, if you'd consistently rebalanced into Europe over the past decade, that would have been a loser's game. You would have been selling a big winner, which is the U.S. That wouldn't have been something that we would have done. It includes, for example, you could have rebalanced out of expensive tech into cheap energy, and that would not have been a way to win in your portfolio. We're always looking for a catalyst. Coming into this year, there was more of a catalyst for energy companies. They're becoming higher up on the ESG spectrum. The reopening trade is positive for energy, a little bit stronger in terms of tighter supply. But you need to wait for those things before you just blindly or automatically rebalance your portfolios, because that can lead you to a loser's game where you're just buying losers that remain losers over time.
So when we talk about, though, I guess some of the more structural changes, particularly coming out of this pandemic, whether you're looking at energy, whether you're looking at tech here, there's a general sense here that you either go for the pure play, so let's say you're looking at renewable energy, you go for a pure play energy company in that space, or maybe you go for a company that's a little bit broader in nature that maybe has a little bit of a buffer if the one big hot thing that everybody's chasing doesn't work out. What's the general strategy there that you're advocating now for clients?
I mean, we're always looking for quality in our portfolios. So it's not so much about just own value versus growth for us. It's which are the companies that can really have leverage to the reopening, revenue growth, earnings that'll beat the cost of capital over a cycle. Particular sectors that we like are the consumer sectors. We think that with the reopening trade still in front of us, consumer stocks should be quite strong. We like industrials because we do see now we're seeing signs of a longer term pickup in capital spending. And we like financials. I heard earlier that one of your guests had been less positive on financials. We think higher interest rate environment, higher inflation, positive for financials. And also small caps. We still like small caps.
Well, that's a disagreement we like. Sarah, in Chicago with Nuveen, the White Sox or the Cubs? Come on. Make a decision.
Actually, I'm in San Francisco, and it's pitch dark, so I'm going to go with the Giants.
You're going to go with the Giants, who are like, what, the best record in baseball. Sarah Malik in San Francisco, thank you so much. We'll ask her about it. She'll get briefed on Cubs, White Sox.
There's only one Chicago team, Tom. That's the White Sox.
That would end this year. That is true. The White Sox are good. Yeah, and what I love about the White Sox, Romaine, is they're still doing, when they hit a home run, they do the fireworks.
Yeah, they still do that.
I remember that as a kid at Comiskey Park.
I did too, Tom. I'm a South Side boy. I stay loyal to Comiskey and my White Sox, or whatever it is. What is it, like Paytel Park?
Yeah, they ruined it.
I think Comiskey's rolling over in his grave.
Let's save ourselves with a data check right now. Futures up 7. Dow futures go the other way, negative 19. NASDAQ, what do we make of the NASDAQ, guys?
I think that this is fascinating because it really does correlate with lower yields. And, it's interesting. Saira was talking about financials, and she was also talking about inflation protection and the concern about higher inflation. What happens if yields go materially lower? Tom, I don't think that we have analyzed that enough. And I think that if that's the risk, right, that if something looks like perhaps the outlook sours a bit and yields go materially lower, then what happens? That could potentially be a bigger risk.
Well, I have a range bound that. I don't know, Romaine, if you can help us here, but a 153.64, I mean, let's be blunt, 149 is unimaginable.
Yeah,
right?
It's unimaginable. And we actually had this conversation on the close last week.
Oh, I'm sure
about
you did.
we did. We have a lot of great conversations there, Tom. You just stay up a little bit later. But the thing is, we talked about how that 150 was kind of the bottom right now in terms of what's priced into this market. I think if you see a real test below 150, that changes that dynamics for a lot of pricing that we're seeing in the equity market.
Very good. We will continue. Much more to talk about. Lisa Abramowicz, Romaine Bostic in for Jonathan Ferro. I'm Tom Keene on radio and television. An important conversation later with David Malpass. This is Bloomberg. Good morning.
With the First Word News, I'm Rishka Gupta. A Senate investigation of the January 6th assault on the Capitol details mistakes made by the government, the military, and law enforcement. A report out today says there was a lack of training and preparation for Capitol Police, who were overwhelmed by the rioters. Police told senators they were left with no direction when command systems broke down. President Biden has come out with a plan to secure critical supply chains in products ranging from medicines to microchips. A task force will focus on supply-demand mismatches and deal with near-term bottlenecks that could affect the economic recovery. The administration is also considering an investigation that could result in tariffs on certain magnet imports. A problem that caused multiple websites around the world to go down has been fixed. That's according to the hosting service Fastly, which has not said yet what caused the outage amongst the websites that experienced problems: the New York Times, Reddit, and the British government. And Amazon is offering 6-month prescriptions starting at $6 for medications for common ailments. It's the company's latest effort to get more people to buy drugs online rather than in a drug superstore or supermarket. Amazon is keen to make headway in the U.S. prescription drug market since acquiring online pharmacy PillPack back in 2018. In China, Tesla's deliveries rose 29% last month from April, when production was temporarily suspended. The electric car maker handed over more than 33,000 locally made vehicles in May. Now analysts are watching to see if it will run out of bad publicity in China will translate into reduced sales. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Down the road, there might be additional hypotheses, but this will take many years before we can see the scientific proof. And as I was just saying, today you have 3 compounds with similar activity, and we are the first one in the market. In a few years, there will be others, and we invite them because the market is so large.
Good morning, everyone. The gentleman from Biogen, Michel Vounatos, they're this morning on this uproar over Biogen and Alzheimer's disease. We welcome you to Bloomberg Surveillance. Lisa Abramowicz, Romaine Bostic, and Tom Keene. And what we thought we'd do is actually talk to a medical expert. We are so fortunate at Bloomberg Intelligence to have Dr. Fazeli with us. Sam Fazeli is our senior pharmaceutical analyst. Sam, you know right where I stand on this. I'm absolutely outraged. Patrizia Cavazzoni of the FDA really pushed back. She was not happy. She's legit pro out of McGill University in Ottawa in Canada. And she said, baloney, there are residual uncertainties. What is she talking about?
Well, Tom, I think she's probably referring to a couple of very choice phrases that the CEO of Biogen used, additional hypotheses. I think he used that phrase. Now, I'm not going to put words in his mouth or try and overinterpret what he says, but we're dealing here with a hypothesis. The idea is that you reduce amyloid in the brain, which is what the FDA has said this drug does, and we agree. And that gives you a benefit. That's where the question mark is.
Well, and Sam, there's really a question, given the dissent that you saw within the FDA panel, of how we can determine which way the FDA will go. Has their process changed at all post-pandemic or just in the past couple of years in terms of erring on the side of, if it can help somebody, why not?
Yeah, but I think, I guess that could be something that's gone on here. But I have to say that I don't think necessarily the process has changed. We've seen examples of this kind of outcomes before. The one before this was the situation with Sarepta's drug for muscular dystrophy. And that's, same kind of eyebrows were raised after that. So I don't want to necessarily call this a paradigm shift in the way the FDA does his job.
Sam, how much does this shift the burden to insurance companies on whether or not to approve this type of medicine, given the expense as well, $56,000 for the medication? Is this unusual for insurance companies to have such an incredible say in whether it's appropriate or not?
Yes, absolutely. I mean, in Europe, we get regulatory bodies such as NICE in the UK who do have that mandate. Here in the US, the FDA approval, the label for the drug is so broad relative to what the data actually was looking at, that it is literally saying to the insurance companies, right, it's your issue to go and figure out whether you want to reimburse this for your members, and if you do, who? So yeah. I'm assuming they're not going to be able to go against what the FDA says, but I suppose they will be asking. I think there's a lot of questions here. My mind's going around circles on this.
Yeah, I mean, not only does the broadness sort of put a little bit more, give a little bit more wiggle room for the insurers, but it also puts a lot of onus here on the doctors as well. And I'm curious as to why the FDA in this particular situation is going to allow such broad discretion to doctors, particularly when it's not entirely clear yet whether this drug is going to actually solve the root cause of Alzheimer's.
Yeah, maybe it comes back down to exactly the issue that we were just talking about earlier, that the data is open to interpretation. Maybe their view is not only the clinical data, I mean, there's also a massive divide within the scientific community as to the importance of beta amyloid. Maybe that's why that is.
But isn't that divide usually resolved during the clinical trial process at some point?
Right. Absolutely. Okay. That's what this trial should have done, right? But unfortunately, it didn't get us that far.
Yeah.
Sam, let me cut to the chase. And I was weaned on this, folks, with microbiology and virology at the Rochester Institute of Technology. You and I have tattooed to our brain the FDA with SmithKline French ages ago having the courage to say no to thalidomide. Have we breached a trust that the FDA earned in the middle 1950s?
There is a risk of that. I mean, those are big claims, Tom, but there is a risk of that here now. I have to tell you one thing. As a member of an expert panel, which I'm not, what is the value of me joining and spending hours and days reviewing data, giving my opinion, only for the FDA to basically say, great, thank you, we're going to do something else.
Exactly. And I'm not going to mince words here, folks. You know where I stand on this. Does the number $56,000 per year have anything to do with this decision tree? No, well, so perhaps. But the other point is, let me ask that question another way. If it was $15,000 a year, is that a better way of spending that money? Because you still have to go through tests, you still have to have the risk of these brain inflammations that you get from this drug. I mean, let's just be clear though, Tom. I, like everybody else, am likely to be touched some way along my life, through my family, and God forbid myself, with this disease. We all want a drug.
We just wish that it was a little more straightforward than it has turned out to be.
Well, we've got wishful science today. Dr. Fazeli, thank you so much on short notice to join us today with Bloomberg Intelligence and our senior pharmaceutical analyst. He's been just great on the pandemic as well. Lisa, your thoughts on that conversation?
It's a massive issue, this question of when do you approve a drug? If there's a chance for it helping 15 to 20% of people who are affected with Alzheimer's, do you allow it to be circulated? Do you make it more mainstream? If there isn't necessarily the scientific backing, do you say we just wait and see? I don't know, but the reason why I asked that question about the pandemic is because we saw the rapid approval of the COVID vaccines, and it was preliminary approval, and that has been really helped things. So at what point do you weigh in on this?
Well, but the FDA already has a process for that. There are compassionate use exemptions. There are sort of other avenues they could have taken to maybe get this out to at least a smaller group of people to actually see if it did have the real efficacy here. Just throwing it out there, it's going to be controversial, and if this thing ends up disappointing.
You've absolutely nailed it. They do the phase 4 testing before they raise the hopes of millions of people touched by this horrific illness.
And it is. And Sam pointed out, too, I mean, this is something, it affects all of us. I mean, so many people have been afflicted with us. We know people who have it. We have people in our families. So we're all really rooting for something here to get done. But there's a way to get it done and not get people's hopes up too high.
But I think, though, that, Tom, just going back to this question that Sam Fazeli raised, that they're really leaving it in the insurance company's hands to decide whether to approve this or not. Well, they have every incentive not to approve a $56,000 a drug unless they actually think it's going to be helpful. But it just really, I mean, talk about the level of power scientifically the different entities have in this country.
And of course, we've seen this debate on cost in cancer drugs as well, moving up $50,000, $60,000, and $70,000 as well. Futures up 11. They advance. The tape is much better than early this morning, even with a digital outage. Lisa Styling in her I survived the Fastly outage.
Oh, yeah.
2021. Look for that at 9 o'clock on the open. Futures up 11, Dow futures up 15, NASDAQ on a tear up 0.6%. The VIX 16.36. Stay with us on radio, television worldwide. Good morning. Bloomberg Surveillance, an eventful day in June on radio and on television. Thank you for joining us from coast to coast. Thank you for joining us worldwide. Some nice comments worldwide this morning, particularly on the digital outage. It seemed to be in America and not so much across. Matt Miller in Berlin earlier making clear he was not enjoying an outage. Romain Bostic and Lisa Abramowicz with me. John Ferro is off, and we're with you with futures up nicely. The raft of economic data, the recalibration of where we are in this great game forward. John Riding joins us right now. He's with Breen Capital, Chief Economic Advisor. A few years ago, he wrote an acclaimed piece on the putting green, the fairway of this Federal Reserve system. He and I will revisit that piece right now because I really don't know, John Riding, where the putting green is anymore. I guess it's out there somewhere. Where is it for Chairman Powell?
Well, for those of you less familiar than Tom with a note of mine from 17 years ago, I think, the putting green, we're talking about monetary neutrality. Now, this Fed is still easing. It's easing because it's buying $120 billion of securities each month. Interest rates are being held at 0% at the short end. And the inflation measures continue to rise. If you want to look at the progress that the Fed has made, if you can call it progress, the Fed would, on 5-year inflation rates, they've moved up from 1.6% when they introduced average inflation targeting in August of last year to 1.9%. They'll go up to 2% probably at the end of the month. So we are at the Fed's inflation target, but the Fed's committed now to a backward-looking process. In other words, it's not going to start raising rates until it's met its inflation target, overshot its inflation target. And so I'm not sure we're playing golf anymore, Tom, in answer to your question as to where the putting green is. This is a very different monetary game, and it spells problems for inflation.
Well, the monetary game of golf that we're in right now is a game of fear. And the greatest fear is, does the Fed react measured a la Greenspan, or do they react in jump conditions and in a state of panic? How does the Fed get to a responsible strategy that gives us gradation without the tantrums for the market?
Well, I think you have to think of a monetary Hippocratic oath. And what's the first rule? Do no harm. So why is the Fed continuing to ease? What is the rationale? Now, on inflation, the Fed's basically at its inflation target. And looking back over a period of time, it is its inflation target. And so what about employment? And here's the key thing. The Fed talks about this jobs gap. It's about 7.5 million from where we were in February of last year. But increasingly, the signs are that it's not the lack of availability of jobs that's preventing people from working. We're going to get another reading on jobs today. We'll probably have another record high number of unfilled jobs. So first, stop easing. And then this Fed's never going to make, as you call it, jump condition. The Fed of 1994, 95, when interest rates moved as much as 75 basis points upwards, those days are gone. But I say the first thing is, let's have a serious discussion about what the purposes of quantitative easing continuing to QE is at the next Fed meeting, and give us some guidance.
John, this is actually exactly the argument that Kevin Warsh, the former Fed governor, made in the Wall Street Journal yesterday, where he was saying the Fed is essentially committing to a policy error that basically it's going to wait longer and then it's going to have to hike rates faster, which will be highly disruptive. What will the Fed accomplish if they slow the pace of the bond purchases, the $120 billion of bond buying every month?
Well, as I said, do no harm. Let's stop continuing to ease with inflation at target and rising. I mean, Kevin Warsh is a friend of mine. We corresponded just a couple of weeks ago. We are very, very much on the same page as far as the monetary policy rules. But monetary policy works in mysterious ways. But inflation is a monetary phenomenon. And if you look, for example, at the NFIB report out today, you have the highest number of small businesses raising prices since 1981. Okay. You've got the third highest reading of all time in the percent of small businesses intending to raise prices. So just stop easing to begin with and then assess.
John,
I don't think the Fed. Yes, go ahead. Sorry.
Are you saying no? I just, what you say and what Kevin Warsh is saying, the implication here is really significant. And I just want to draw a line on this. Are you saying that the Fed is going to cause another financial crisis by allowing risk to build in markets, for risk to build up with their easing, and then have to hike rates much faster than people are currently expecting?
Well, the Fed won't hike rates for a financial crisis. If we go that far, the Fed will be finding new ways to ease. What I am saying is that the Fed is feeding an inflation problem. And right now it's not a problem, but there was a very interesting article in the Wall Street Journal about commodity prices and inflation. It reminds me of my former colleague from Bear Stearns, Wayne Angel, who was very influential in talking about the monitoring commodity prices and the story for inflation. The monetary message is clear with a lot of commodities at record high prices. And a lot of CEOs basically saying these aren't transitory events. Now, the Fed's saying this inflation problem is going to be transitory, so they don't need to respond to it. But public inflation expectations are rising, business inflation expectations are rising, market inflation expectations have risen. They've leveled off for a little bit, but I just think that's a market move that we're going to see higher inflation break-even.
So some of the distortion that we've seen with regards to expectations out there also has to do with people trying to make a distinction between inflation and actual cost of living. This idea here that the two aren't necessarily in sync the way they would have been in the past, and that you can sort of make concessions to one with at the same time still being loyal to the other, John.
Well, that's a great question. What's the most important thing about living? That's a place to live, right? Now, house prices are going up about 20% per year right now. That is a very, very rapid asset price inflation. But how does that materialize in the CPI? It puts downward pressure on rents and actually leads to a CPI that is rising more slowly than would otherwise have been the case. So the desire to move into owned accommodation and pushing up the price of an asset, and that is a cost of living, it is being manifested in a slower inflation rate. Yet despite that, we've got the last CPI reading year over year was 4.2%. We get another one later on this week. And I think that's going to show even more upward pressure.
When we talk about this idea here of personal savings that skyrocketed, obviously, during the pandemic, it's obviously come down a bit. It's still relatively elevated compared to what we saw in 2019 and the years prior to the pandemic here. The idea, though, that the savings rate hasn't come down as quickly as some economists had originally forecast, does that sort of blunt maybe the potential impact of persistent inflation?
I don't think so. And it's a great point you make about savings, because firstly, there's the accumulated savings, which are savings that wouldn't have been made had there been no pandemic. And they stand at $2.5 trillion, and they're held most in liquid form in bank accounts. So that's more than 10% of GDP is, in terms of spendable funds, is readily available. And then you have the additional fact that people are still saving more. And why they save more? Because the economy is not fully reopened. But new cases of COVID over the last 7 days are down 81% from where they were on April 13th, which was the most recent peak. And the economy is reopening. And a lot of those funds can be deployed. And we don't know when they're going to be deployed. The Fed doesn't know when they're going to be deployed. What's going to be the impact on prices when they are deployed? We're seeing you can't produce enough cars, so used car prices are putting a lot of upward pressure. That's a big part of the CPI last month. In April, report will be an important part of the report, I think. You'll see airfares going up. You'll see a lot of areas and services adding to the pressure that we're seeing from the goods economy and the commodity economy.
John, I got to leave it there. John Riding, thank you so much, with Brean Capital, their chief economic advisor. What we're going to do is parachute in right now. Ivan Feinseth with us with Tigris Financial Partners here on what we observed today from Fastly and an internet outage. Ivan, you are expert at the review of the companies like Cisco that make the stuff that we take for granted. Does AWS, does Google, Microsoft, and for that matter, does Fastly take for granted the solidity of their systems?
Well, I don't believe these manufacturers take this for granted. I believe end users, the consumers, they always believe that the Internet's going to work, it's going to work well, and it's going to be fast. However, we are in an environment where there is all kinds of cyber attacks just to be disruptive and cyber attacks to hold companies for ransom, to disrupt businesses, to create an anti-competitive environment. So there's a lot of vulnerability, there's a lot of security, but this, again, highlights the importance of redundancy in the networks, security in the networks, and more, in the beginning, speed of the network, and the network worked through the sophistication of the hardware. More and more, a lot of these networks are software-defined networks, which are relying on the sophistication of the software and relying on the software to provide increased security. And also, we need this constant rerouting, what a company does like Fastly, for example, to maintain speed, because just like when you're driving on the highway, internet traffic can have traffic jams if everybody's trying to go to a certain website at once for a special deal to read a news report. So
there's also
it's important
a question,
that we maintain it.
There's also a question about the visibility of some of the breakdowns, breaches in security or other cyber issues. How good is our visibility into when a company either gets hacked, has a disruption, et cetera, especially if it doesn't necessarily make it into a disruption that we can see?
Well, it's only as visible as the situation is quickly rectified or it becomes a problem. It's only a problem until it's a problem. If it is a major ransomware denial of service attack, and a company may have to call in another company or make arrangements for some kind of payment to remove the ransomware, then it may hit the headlines. It may be a significant issue for the company, but if they have other servers they can reroute to, so it all, again, depends on the strength of the IT infrastructure, which is also part of the importance of this infrastructure bill is that we continue to build out the robustness of our communication infrastructure and our power grid.
Ivan, thank you so much. Ivan Feinseth with us with Tigris Financial Partners and their CIO. Lisa, we talked about a 149 10-year. We're halfway there.
Honestly, the move lower in 10-year yields has really been striking over the past couple of minutes even. We're back down to 1.516%. A pretty sharp move based on my terminal, and I'm trying to figure out why. There isn't really a whole lot of data coming out showing this, which really proves there is some sort of technical push with so many people positioned for higher inflation that if we start to get lower yields, perhaps momentum goes much more quickly. And Romain, you were talking about that too.
And it's interesting to see too, I mean, coming in with 5 basis points on a day where you're not really seeing a lot of movement in the dollar, it does sort of wonder where that cash is coming from and why it's moving into treasuries at this point. You start to test that 1.5 level. A lot of strategists, equity strategists say really keep an eye on what's going to go on, particularly with the NDX and some of the bigger cap companies.
Well, and I will just say Ed Al-Husseini who was on earlier today, just messaging in and saying that the U.S. Treasury futures have been sold in Asia over the Asia hours, and then a bid comes in for the U.S. hours, and that seems to be what's happening right now, Tom. I mean, really, that bid is coming in with a tear.
Well, it's coming in with a tear. The velocity here of lower yields front and center. Lisa Abramowicz will drive forward to the 9 o'clock hour. In that hour, a conversation with David Malpass of the World Bank Bank's view of the global economy. Stay with us on radio and television. This is Bloomberg.
What the Fed is saying is we may not raise rates and allow inflation to be higher than the target for a period, whereas she's saying, well, higher rates might be a good thing. So I do think this is a bit confusing for the market at the moment, and it would be quite good if we had one consistent message from the US.
Sir Howard of NatWest there, commenting on the markets and the messaging of our economics of the moment. Howard Davies with us yesterday across Bloomberg. Futures up 9, Dow futures up less, NASDAQ futures up more. Maybe a pretty optimistic day in the markets with the VIX 16.39. 14 things to talk to Barry Ritholtz about. Romain Bostic and Tom Keene, Lisa Abramowicz preparing to drive the network forward in the 9 o'clock hour. Barry, I've got to go to the rebalancing debate. Simon Constable in the Journal getting it started a few days ago. We just heard from the gentle lady from Nuveen, Ms. Malik, who was talking about it as well. Let's go to the authority on this. And I say this, folks, with great respect, because Barry actually runs Real Money. Barry has to either rebalance or not rebalance and has some experience. To me, Barry, it is about the Sharpe ratio of one William Sharpe of Stanford, and that we are completely return-based in this industry and less volatility-based. Discuss.
So these rebalancing articles come along every couple of years, and I always feel they should start with a disclaimer. This week's column is brought to you by Hindsight Bias. Hindsight Bias, telling you what you didn't know 2 years ago. And that's the problem here. Well, if technology is going to keep going, if stocks going to keep going up, if bonds are not necessarily going to do well, and if emerging markets in Europe are going to lag, well, of course you don't want to rebalance if your goal is to maximize your performance. But that's not the point of rebalancing. The point of rebalancing is to maintain a portfolio that is consistent with someone's risk tolerances and financial plan. And again, when you're making the do I rebalance or not decision, you have no idea what the hell's going to happen over the next 12, 18, 24 months. So you're aiming for a median sort of approach.
But Barry, what's so important here within the Sharpe ratio, there's no beta in the Sharpe ratio, folks. There's no fancy mathematics. But what there is the variance. There is the up and down of the daily game. Basically, the media and the pros look at return, and they don't look at the variance, the risk taken. As you say, how do our viewers and listeners focus on risk and less on return?
So the idea of rebalancing being a little bit of a free lunch over long periods of time is that rather than guess, do I rebalance here or not? You basically say, here are my parameters when these asset classes are more than X percent away from our original core percentage weighting. We'll rebalance because it means you're selling a little bit of what's gone up and might be a little pricey, and you're buying a little bit of what's gone down and is a little bit cheap. And doing that around the margins over long periods of time theoretically adds, pick a number, there's different studies show different things, 25, 45, 65 basis points in performance over long periods of time. But again, we're not doing it for the performance. You're doing it to stay on track with a financial plan.
Yeah. What's so important here, Romain, is Ritholtz is using the phrase little bit.
Yeah.
That's the distinction.
A little bit. And look, this debate comes up, I think, anytime you get to a market top or what's perceived as a market top, and people start to wonder, okay, you don't want to sort of miss out on whatever the next great rotation may or may not be. Barry, I am curious here more about the idea of safety and hedging, I guess, for the potential that, maybe we've reached the top, maybe we've reached some sort of peak here. And if you're an investor here, is the idea here, when within the context of rebalancing, less about sort of, let me jump on the next big train moving out of the station, and more just protecting whatever I've made so far in terms of profits?
Well, remember, when you're doing the rebalance, hypothetically, you're a 60-40 portfolio, and each of those, the 60 is broken into 5 or 10 different asset groups, U.S. large cap, small cap value, emerging market, whatever it is. Some of those holdings may be 10, 15, 20% higher than where they were when you did the rebalancing a year ago or 6 months ago. Yeah. And so the idea isn't, you're not market timing, you're not trying to pick a top. You're saying, hey, this group of asset classes, by our pre-established rules, you're not doing it on the fly, you're not reacting emotionally. These are our rules for rebalancing. These have exceeded our parameters. And so we're just going to trim back a touch. So when the market is up 75% over 12 months, which in itself is a little misleading because it was up 17% over 13 months, back out the crash and recovery, and it's a sort of normal 12-month, 13-month period. Yes, of course, if you're rebalancing. Now, P.S., the flip side of that is you could set up a variety of parameters that anytime the market drops, fill in the blank, 20, 25, 30%, you're going to rebalance. And in that circumstance, you're rebalancing into equities. I wrote something a couple of months ago about our direct indexing software that we use with O'Shaughnessy created it. And that rebalance took place about 28 or 30% down. And it was not only a giant moneymaker, it was a giant tax loss harvester. So I try not to emphasize these, outlying up 50%, down 30% as this is what you should do when you're rebalancing. You want something consistent over decades, not market timing or not reacting to whatever's happening that moment.
Got to leave it there. Barry, thanks for the clinic. Barry Ritholtz with Bloomberg Opinion there on this great debate of rebalancing as well. I just remain, we've been remiss, and we've got to spend our final 9 seconds.
Yeah. Talking.
AMC
again.
Up fractionally. I mean, it's on the bid this morning, and I got to look at it technically up to the 70 level, down to the 50 level, and now midpoint 55-ish. I mean, it's almost technically legit.
Almost technically legit. Under $58. We'll see if it gets back down into the 30s, and maybe it makes it a little bit more legit. You talk about this rebalancing debate, Tom. I mean, he mentioned the 60-40 portfolio, but so many people have moved out of that 40 and put part of that 40 into, crypto or whatever you want to call it, alternative assets here. And I wonder, what portfolio balancing do you do when you start to see these drops in some of these alternative assets?
It's a raging debate, and my job is to stay out of the debate. It's full disclosure. I'm not a fan of rebalancing, but Ritholtz in the real world goes to the heart of it, which is you don't sell, say, Apple to buy JP Morgan, just as to pick one idea. At the margins, you move some out at the margins to buy some more there. There's a graduality there that maybe gets you through avoiding the bad mistakes.
Yeah, I like these meaty discussions that we have on this show.
We're just, we got William Sharp into it. It's one of my favorite people. Folks, it's real simple.
My wife just messaged
Forget
me and asked me
Trainer
Sharp.
and Jensen and focus on Sharp. That's according to philosopher Romain Bostic. Futures up 8, red and green on the screen. Stay with us. David Malpass in the next hour. This is Bloomberg.